we're looking for a strong payroll report.
I think the labor market is basically chugging along. It's tight. We're not adding a lot of new jobs.
The labor market, our view is it's slowing, it's weakening.
If the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed.
If we just see similar softening in the labour market over the next couple of months, then I think the Fed will be ready to cut come May.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Payrolls Friday, heading towards a fourth week of gains in the equity market. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market positive on the S&P by 0.5%. Only one name matters this morning. It's Meta, otherwise known as Facebook, up in the pre-market by almost 17%. We're talking about a $1 trillion name here, trading like a penny stock. The Southside reaction, Bramo. Morgan Stanley, solid execution. Jefferies exceeded high expectations. Evercore, one of the most impressive quarters in a while.
It had to do with advertising. It had to do generally with efficiency. And it had to do with the $50 billion increase in its share buyback authorization, which to me was shocking considering that a $50 billion increase in its share buyback authorization led to an almost $200 billion increase in its market capitalization in just a couple hours.
Bob Iger thinks he runs a big company. We're talking about a Walt Disney added in the pre-market, Lisa. This is huge.
And it really raises this question of, OK, you've got a company that reported free cash flow of $43 billion. You have an increase in advertising. Are they just consolidating advertising share? Are they growing in the AI space? Or is it just that the expectations were so low and the efficiencies got into a place where suddenly people can buy into this name?
Now, compare that to Apple. Let's talk about Apple. In the pre-market, looking like this, we're down here by almost 3%. The Southside reaction to this name, very, very different. Vital Knowledge, the release is just OK. KeyBank, expectations need to move lower yet again. The disappointment here, Annmarie, China.
Which is the completely different story from Meta. Meta did so well when it came to advertising in China, really all those ad dollars coming up. When it comes to Apple, 13% decline in China. And my question is, how long will we see this weakness coming out of China for Apple? And what does it mean for their growth going forward?
Lisa, down 13%. Let's talk about China a little bit more with regards to Apple. How much of this is FX, competition, or nationalism in that country? Because that's going to give you an idea of whether this is really temporary or not.
And it raises this question of how much are they going to leverage their growth to China, given all of those headwinds, the FX, the competition, as well as some of the nationalism. Because at this point, if they're counting on this as being their growth area, it's kind of running into some big problems.
Let's check out the equity market more broadly. It's not about Apple, it's about Meta, it's about Amazon. Equity futures on the S&P 500 doing OK, positive by 0.5%. The 10-year here at 388.17. Yields going absolutely nowhere. In the FX market, 108.86 on euro dollar, positive by 0.1%. Coming up this hour, Greg Bowdle of BNP Paribas on the earnings-fueled equity rally. Bloomberg's Alex Webb with growing divides in the Magnificent Seven, and Sarah House of Wells Fargo ahead of the latest US payrolls data. Bramo hardly even talked about it. Pause. 3 minutes into the show. It is Payrolls Friday. 185 is the estimate.
I was looking actually to see what anyone wrote ahead of this, to see if anyone wrote anything particularly interesting. And none of the notes have any more interest than what we're putting to it. I mean, basically, people are like, OK, it's going to be decent. We're not going to learn that much and everyone's going to move on. And we've moved past the idea of a March rate cut. It's essentially a non-starter unless you get some sort of big surprise one way or another. And then suddenly people will totally change.
Well, you say one way or another. I'm going to say one way.
Yes, correct.
And not another. If you get a big downside surprise, then I do wonder how we start to read Chairman Powell's comments from just Wednesday.
Do you start to put March back on the table in a much more material way? On the flip side, what about wage inflation? Yesterday, we got ISM manufacturing and prices paid surged.
True.
No one's talking about this. So at what point are people discounting exactly that, the strength, the inflation, and they're really looking for the weakness to justify a walk back by Jay Powell?
Payroll's due at 8:30 Eastern Time. We begin with our top story, an earnings-fueled equity rally. Greg Bowdle of BNP Paribas saying to avoid the extremes, quote, our preferred part of the market is to be long the body of the distribution like equal weight S&P 500. This avoids the tails that are either too risky or too expensive. Take a listen to this line here. The NASDAQ 100 is our top US index short. Greg Bowdle nodding along. Good morning, sir. How painful is that?
Yeah, I think it feels like Groundhog Day, doesn't it? Another tech beat and Nasdaq grinding higher again. But our view is that valuations do ultimately matter. We think the NASDAQ as a whole is pretty expensive, but we do think there are more targeted ways to play the winners or losers within NASDAQ and get exposure to things like the secular AI theme, which is something that clearly is not going on.
So, Greg, betting against it and avoiding it are two different things. Why bet against it?
So I think that the valuations we think matter in terms of the NASDAQ. And when we look at some of the cyclical drivers, the macro data has been coming in better at the start of this year. And historically, some of the industrial cyclical parts of the economy that have lagged have been better correlated to that. So equal weight S&P is something that we think is an interesting part of the market in which to hide, where we think you get a better combination of or balance of quality and value.
Did you feel a little sick to your stomach when you saw the earnings yesterday?
No, I think the earnings is something that we've been seeing for a while, this kind of better backdrop from large cap tech, but it has been mixed. I think when we look at the Magnificent Seven, you look at the performance this year, there's an awful lot of dispersion. We have a name that's up 25%, we have a name that's down 25%, and I think it's a story of relative winners and losers. We think that if you want to play some of the more sustainable bull stories within tech, there are more targeted ways to do that than the headline indices.
Is it within specific industries that are going to be adopting some of the technologies to become more efficient? Or is it just to consolidate all your bets at NVIDIA and then go into small caps as sort of like a barbell approach?
Yeah, the way that we've discussed doing this is we created a targeted basket of names that we think exposed to the secular AI theme. But rather than just buying any stock that's exposed to AI, we came up with this narrative of what are the kind of second and third stages of the AI cycle, some of the platform names, some of the software names. So we've constructed a basket of names that plays to that. The issue with it is that those names are also expensive. They trade on a 30 times forward PE. So what we've been looking for is some shorts to pair that off against. So we've had a look at taking the NASDAQ names that have the worst earnings momentum, screen poorly in terms of free cash flow yield, and we've put that together as a barbell trade. That's about 8% on side this year.
We had Mike Wilson of Morgan Stanley sat in your chair just yesterday, talked about the difference between AI enablers and AI adopters. How do you frame those two things right now?
Yeah, so I think the challenge with AI is that it's such a fast-moving story, and it's been very led by hardware at the start. And it's a question of where are we going to go in the next coming couple of years. So for us, it's looking at trying to build a collection of stocks that we think have that exposure and have that momentum. But importantly for us, it's finding hedges against that, given what are very elevated valuations across the board in life.
Can we introduce the Federal Reserve into the conversation too?
Yep.
Does the Fed have a more risk-friendly reaction function now, given that we know they welcome strong data and they're willing to respond to weak data?
Yeah, I think that what we saw in November and December last year, the pivot from the Fed was obviously kind of game-changing for equities. We saw a huge rally at the back end of last year. The question is, how does the marginal data affect markets from here on? And I think with this cutting cycle now priced into the market, we do think that the Fed and this more dovish backdrop that emerged at the back end of last year is constructive for equity markets. But it's hard for the Fed to kind of introduce this kind of positive step change that we saw in November and December. And if anything, the risks there from the Fed in terms of reaction function look a little bit more balanced given what's priced in now.
Okay, just to put it another way, is bad news bad news? Bad news economically, bad news for equities? Or is bad news good news on the margins if it's not too bad and it causes the Fed to maybe move forward some of the rate cuts?
I hope TK's still in bed.
I know, but this is exactly
what people are talking
about.
And I'm not sure he is yet. He'd be throwing things at the TV.
He's throwing Tang at the TV. All right.
I think bad news is bad news. I think in terms of the timing of the Fed cuts, I think what we saw was a big pivot in November and December that kind of changed the narrative regarding the Fed. Whether the Fed cut in March or May, whether they do 4 or 5 cuts, I don't think changes the picture really for equity markets. It's more the path that's important.
I have to go back to something you said, where you said basically the way that you're going to hedge some of your bets is by shorting select companies that don't have the right momentum. Are you shorting Apple stocks?
Well, we don't make calls on individual names. What we're trying to do is put a basket of stocks together. Now, Apple appears in 2 of the baskets that we pitched this year. One is short US names exposed to China, which I think is a theme with the US election at the back end of the year, which is just absolutely not going to go away. And it's also in our basket of broader consumer-exposed stocks that we think are potentially at risk of more of a slowdown this year.
So yes, basically. But I am wondering if going forward, this is sort of a theme that you expect to play out over time, that basically this is an idea that the trends are correct, but some of the companies that are exposed to other things are going to get held behind. Is that dependent on the Fed? Is that going to be something that plays out in the first quarter, second quarter, third quarter?
I mean, it's clearly dependent on the Fed, but I think our view is that you need a material change in what the Fed has communicated for the Fed to become the primary driver. I think that growth is more important, and some of those micro trends, whether it's the US election, whether it's exposure to China, or whether it's growth in terms of the secular AI story.
When it comes to exposure to China, does it matter if it's Trump or Biden in the White House in 2025?
I think it probably matters, but it depends a little bit what they're going to enact in terms of policy. But I think as we move towards, or as we move through this year and we get into the election cycle, it's unlikely that the rhetoric from either side towards China or towards trade more broadly is going to be positive for equities with that exposure.
Right. The rhetoric is going to get hotter. But when it comes to, say, things like trade tariffs, Biden kept the Trump-era tariffs in place. Isn't it just the same policy and a little bit of a maybe multilateral approach versus a China versus U.S. approach?
Yeah, I think there is risk of escalation of that policy, but I'm not sure that there's a particularly dovish outcome from trade from either party. So I think as we move towards the US election, you're going to get a ramp up in rhetoric, and you run the risk that you do have more hawkish policy from either party going forward.
This shift in nationalism, I think domestically in China, Lisa, is the one to watch.
Absolutely.
Been talking about it for a while now in Apple. That weakness is really hard to ignore in those Apple earnings yesterday.
And the fact that they doubled down and said that they still consider China an area of growth.
What can they say?
But this is exactly right, because they're hinged on both sides, from the employment side as well as on the sales side. This is one of the reasons why people are so worried about it, and Greg pointed in his bucket of China-exposed stocks.
Hey, Greg, great to have you with us. You're going to stick with us. Great battle there of BNP Paribas. Broader equity market, positive here by 0.5%. You can thank Meta and Amazon for that. Let's get you some top stories this morning. Elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Russia struck a power substation in central Ukraine in a drone attack, according to a Telegram post from the power grid operator. According to local authorities, over 40,000 households and 2 mining operations lost power, initially stranding 113 miners underground. The strike follows a series of attacks the past several weeks targeting critical infrastructure in Ukraine. Billionaire investor Nelson Peltz has formalized his pitch to Disney in a long-awaited letter to shareholders. In the letter, Peltz questions the company's planned investments in its parks and cruise line divisions and suggests bundling streaming platform ESPN Plus with a service such as Netflix. In response, Disney's board says Peltz brings no media experience and has presented no strategic ideas for Disney. Peltz owns around $3 billion in Disney stock. Meta CEO Mark Zuckerberg stands to receive a payout of about $700 million a year from the social media giant's first ever dividend. He's already the 5th richest person in the world, according to the Bloomberg Billionaires Index. This payout will be a nice boost to the $27 million he took home in 2022. And that's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, some stocks are more magnificent than others.
You cannot question the spectacular financial management here.
That's coming up next, live from New York City this morning. Good morning. Live from New York City, equities positive here by 0.5% on the S&P 500. It is payrolls Friday. Your estimate is 185K. The median read of the survey here at Bloomberg, the previous number 216. Under surveillance this morning, some stocks are more magnificent than others.
In terms of applying AI to advertising, Meta was a little late. Originally, they were thinking of it in other ways, but they have done an extraordinarily good job of applying it. And I think in this case, AI is helping drive revenue and profit growth more than for most of the other big companies. You cannot question the spectacular financial management here.
Here's the latest this morning. Meta and Amazon surging after blowout earnings reports, cost cuts and plans for AI, and both companies fueling investor optimism. Apple lower in the pre-market as concerns over sales in China continue to deepen. Joining us now to discuss is Bloomberg's Alex Webb. Alex, let's go straight to Apple. What's going on in China?
Yeah, it's not good news. The market was expecting it to be not brilliant news, but it was slightly worse than expected. They were looking for about $23.5 billion in revenue from Greater China, which also includes Taiwan, in the quarter. In the end, it was less than 21, I think. So more than a 10% miss there. And it's all to do with the sort of rise in patriotism when it comes to the devices that people are buying. We saw this 6 or 7 years ago where Apple experienced a bit of a dip, lost a lot of market share. Also, Samsung lost even more market share as there was a rise in brands such as Oppo, Vivo, Xiaomi and Huawei. We're seeing a similar phenomenon right now, and it's a lot worse than people had expected.
So how do they fix this? Tim Cook went to China, I believe, at least twice last year. Do they need to do more in terms of integrating their products into the Chinese economy?
Yeah, it's a challenge, isn't it? Because, of course, they don't necessarily have the same ability to kind of get their claws into consumers there, right? Because a lot of the online experience in China and large parts of Asia is through super apps like WeChat. Of course, they do have a services business in Asia, but when you think about the apps that you download onto your smartphone in Europe or the US or Africa and South America, every time you download an app, every time you take a photo, that makes it harder to port everything over to a device running on the Android system. It's a little bit harder to do that in China. What we did see, though, was that Apple still beat on revenue on the top line. Part of that was to do with Europe, which did post better numbers than many people had expected. So I think what we're seeing with Apple is leaning into other growth economies, not least India, in the hope that starts to pick up some of the slack.
It's Jobs Day, non-farm payrolls, and I'm going to connect it to both Apple as well as Amazon and Meta, this idea of how many people can Apple cut from its workforce at a time where Amazon and Meta were really extolled for all of their job cuts and talked about efficiency and operating in a leaner capacity going forward.
Yeah, it's a little bit harder for Apple because it's been very canny in the way that it manages its workforce. It doesn't have, I think it's got just over 100,000 employees. Amazon has 1.5 million employees. But of course, Apple does employ millions of people indirectly through its contract manufacturers. It means that these are not people that it has to pay when it is not manufacturing devices. That doesn't mean there might be scope for a little bit of trimming around the edges, but actually Apple is just remarkably good at managing its cost base. Even as we see a slowing down on the top line, we're still seeing margin expansion and an EPS expansion because they are really canny in the way that they manage their costs.
Where is growth going to come from? We walked past the Apple store this morning and we could see that huge sort of goggle sort of light that was on the front of it, and people are going out, maybe getting these virtual reality headsets. Is that really going to be the driver, or is that really one of the existential questions also underpinning some of the angst?
I think in some ways investors have stopped really caring quite so much about that question. I don't think that the Vision Pro and whatever comes subsequently is going to be delivering a new leg of growth anytime soon, maybe in the medium term. This is still very early days. Think about how long it took for the Apple Watch to gain traction and gain adoption. It probably was sort of 4 or 5 years, and this device right now is a lot more expensive. What we have, though, managed to see with Apple is that expansion into services, which has been the fastest growing part of its business for several years now. It's also, on the whole, a higher margin part of its business. The challenge is what it's facing on the regulatory front. We've seen in Europe that it's been forced to open up the ability to download apps from places other than Apple's own app store. That starts to chip away at the edges of that business. But you can never discount Apple. They somehow always manage to just squeeze out a little bit more earnings growth, even as the top line looks bad.
Alex, great to catch up. Alex Webb there of Bloomberg. Bit of breaking news for you. The former president has alluded to this before, but in a Fox Business interview, Donald Trump wouldn't reappoint Powell as Fed chair. Lisa, we've had a hint of this over the last few months, but back on a radar again.
And he's only going to be more in the front and center when he cuts rates, and he'll be accused of trying to boost the U.S. economy ahead of the election to give Biden a win. That will be what certain people allege. Doesn't come as a huge surprise. It just shows why this is going to be such a hot potato for the Federal Reserve in the upcoming months.
Would Powell want reappointment? Is a very different question, right? I think the term is up, AMH in 26.
Yeah, exactly. And it wasn't just that. Why would he reappoint him now? He attacked him so much, even though he was his Fed pick. I do remember when he said, who is the bigger enemy to the United States of America, Jay Powell or Xi Jinping? Do you think Jay Powell actually wants to be put in that position again?
Greg Battle, BNP Paribas, with us around the table. Greg, over to you. No, we'll ask about politics. When do you start to consider these things? When does this really get on your radar where you just can't ignore it anymore?
The election's an incredibly challenging thing to trade because we have a lot of water under the bridge in terms of earnings season, how the first half macro narrative plays out. The thing that we suggest trying to do is either find asymmetries within the option surface that can allow you to put on, say, a calendar trade, or find a structural trade such as US names exposed to China that we think maybe there's some catalyst for that to work in the meantime, and then has a kicker from the election.
If you think it's going to be Trump, do you have a playbook because he already was in office?
So you can go back to 2016 and say, what were the stocks that moved around that election? What we saw was a massive rally from domestic cyclicals, things like the Russell outperformed, China-related stocks lagged. The question is kind of where are we now versus 2016? A big reflationary rally is probably less on the cards. So I think chasing something like Russell, given the move that we saw at the back end of last year from the small and mid caps, is less obvious. But I do think things like that China-exposed US stocks is a pocket of 2016 replay that we can potentially lean on.
One of my frustrations with Washington, D.C., one of them, is just it's very difficult to get the noise from the signal and to really decipher the two. And I wonder, as someone who's actually putting money to work, when do you take a policy on face value, say 10% tariffs across the board, start modeling it out and trading off it? Some of the rhetorics that you know is going to be harder lying now than it's going to be later on when it gets watered down and put through all of the congressional hearings and then comes out.
Yes, I think it's an incredibly difficult thing because when you think about probability weighting this, it's what's the probability of the candidate winning, what's the probability of them being able to enact the policy, and then what impact does that actually have to markets. So I think putting a trade on now, purely for the US election, is probably a little bit too tricky. But what you need to try and do is find, are there trades that you think make sense for another narrative and the election potentially acts as a kicker? I think that's a more rational way.
In the here and now, we're trying to figure out where the economy exactly is. And I have to say, we haven't really been talking about payrolls and how people are going to trade it. How are you going to trade it? I mean, what are you looking for? Are you going to trade it?
I mean, the macro data at the start of this year has just continued to be much more resilient than people expecting. We saw the better GDP print, we saw the better ISM print, so I think it's not obvious to us that we're going to see anything other than a robust payrolls print. So I think one of the things that we've suggested is looking at the parts of the economy that has lagged, and if the data does continue to come in a little bit better than people have expected, how can we play that from a rotation sense? So what we've seen is the industrial cyclical parts of the economy bumping along the bottom in more of a correction for the past 12 months, and you can see that the ISM in contractionary territory. So we think potentially there's room for a catch-up trade there. So that's really what drives our view of being long the body of the distribution in terms of equities, equal weight S&P that we think has a bit more leverage to potential for a relative recovery from some of the industrial cyclical parts of the economy.
Here's the question Lisa wants to ask. I'll ask it for her.
Thanks.
How low does the jobs print need to be today to talk about rate cuts again in March?
I'm not sure that today's job print is going to be the catalyst for that.
50? 80?
You don't know me.
Possibly.
That's totally what I would want to ask.
Right?
Carry on.
Yeah. So, no, I think that the inflation print is going to be as important as the job print as we move into March. But as I've said, for equity markets, I think people are obviously very fixated as to whether they move in March, whether they move in May. Do they cut 4 times, 5 times, 6 times? I don't think that makes that much difference for the narrative of the equity market.
Interesting.
I think directionally what matters is, are we in a cutting cycle? Is that going to start in the first half of this year? If so, I'm not really sure the level of detail as to when they kick that off is really going to change where we're at for the equity market narrative.
Greg, it's good to see you.
Thank you.
Always is. Thank you, sir. Great battle there of BNP Paribas. Not constructive at the index level, the market cap index level, S&P 500. Looking at that equal weight. Still want to go back to Stephen Stanley, Santander, yesterday. Standout conversation for me. He said you'll get 50 basis points of cuts this year, and it will come after the election. You're not going to get a move until after the election from this Federal Reserve. It's the call from Santander.
This is how out of consensus he is. Right now, there is a 106% chance of a rate cut in June. So basically, you're pricing in more than one rate cut fully into market expectations. So he is definitely contrarian on that.
There is a belief that they're going to go further and further, but Stephen's pushing back. You know what was so odd about Stephen's call? It felt so foreign. It felt so foreign, yet it's only one cut away from the dot plot from the Federal Reserve back in December.
It's, you know what, I think that a lot of people are going to have to really look at what he's saying, especially if yesterday's ISM data was indicative of the new trend.
Coming up on the programme, Sarah House of Wells Fargo, ahead of the US payrolls report. That payrolls report is just around the corner. Equity futures are positive here by 0.5%. Meta is absolutely flying in the pre-market. More on tech earnings still to come. Live from New York, this is Bloomberg. Equity futures picking up here on the S&P 500. We're doing better than good on a week, even with the biggest one-day loss of the year so far. In fact, the biggest one-day loss going back to September on the S&P. We're still grinding towards a week of gains on the S&P 500, looking at a fourth consecutive week of gains, up by 0.6%. Surprise, surprise, the Nasdaq up by more than 1%. In fact, Bramo, it's pretty impressive when you think about it. We've got the Nasdaq 100 up 1% and Apple's down in the pre-market. You can thank Meta and Amazon for this.
The fact that a more than $1 trillion market capitalization stock is up more than 16% in the pre-market trading gives you a sense of just how massive the Meta gains are. And yeah, sure, it's a 1% gain. We're talking hundreds of billions of dollars of market capitalization created in a heartbeat.
This is where the excitement is right now. It's in the equity market. It's not in bonds. At the front end of the yield curve, yields are up by 3 basis points, 4.23. We'll talk more about the jobs market a little bit later, but the estimate in our survey, 185,000. The unemployment rate, 3.8% is the guess, or the estimate to be polite. The previous read, 3.7%. Just to finish on foreign exchange for you, here's the euro against the dollar. The euro against the dollar looks like this, 108.83, positive by 0.1%. Under surveillance this morning, tech earnings in focus. Meta, Amazon surging after cutting costs and continuing to invest in AI. The year of efficiency paying off for Meta's Mark Zuckerberg and investors too. The company announcing a $50 billion stock buyback and its first ever quarterly dividend. Apple shares falling after reporting a slump in sales in China. The iPhone maker snapping a streak of 4 straight quarters of declines. Not enough to boost this stock. We're down about 2.7%. AMH is all about China and the difficulties they've been having there for quite a while now.
Absolutely. CEO Tim Cook is trying to say it's also about this currency issue when it comes to what's going on in the FX market. But isn't this just about the fact that they're losing market share, and purposefully so? The Chinese government is allowing some workers to use iPhones. How much longer is this going to persist in Beijing?
Luca Maestri nailed it, the CFO at Apple. None of the happy talk. This is the most competitive market they're in, and you can see it right now.
And maybe if that's the opportunity for growth, it's the reason why people aren't very optimistic. I also am struck by how it's just a different model. I mean, Magnificent 7, are we talking now Magnificent 6? When's it going to be a Magnificent 2? Because they're different models, right? You look at Amazon and the web services and AI and how they're incorporating it. You look at Meta, they don't need as many workers. It's not as intensive as what you get, at least not the warehouse business for Amazon, as Apple. It's so different from a supply chain standpoint that it highlights why you might be getting a gravitational pull.
It's so true. When he started talking about the year of efficiency, I don't think we thought the stock would be up 200% last year. It was up 12% before the report yesterday, and we're up another 17% this morning.
He was asked whether he wants to invest and expand after becoming efficient and having all those job cuts. And he said this: I've really come around to thinking that we operate better as a leaner company. It raises this question about whether some of these behemoths can continue to contract their staff while continuing to expand some of their profits and cash flow.
That's the latest in tech this morning. Here's the latest in the Middle East. Talks continuing in an effort to de-escalate the war between Israel and Hamas. Bloomberg reporting that negotiators are waiting on Hamas to respond to a deal that would see a 45-day pause in fighting. Prisoners and hostages would be released in stages. Parties from Qatar, Egypt, Israel and the United States see this as the best chance yet to eventually end the war. According to a US official, Secretary of State Antony Blinken, AMH set to make his 5th trip to the region in the coming days.
Yeah, the U.S. really wants to get this deal done. There's a lot of pressure domestically on the Biden administration. We see that especially in key states like Michigan to try to ratchet back what Israel's doing. Right now, though, the Qataris will tell you this deal has been on the table for weeks. Whether or not Hamas and whether or not Netanyahu is going to accept this, and this can continue, be one of the longest pauses we've seen in the fighting since it began. I mean, really wait and see, and that's likely why we'll see Blinken go to the region.
I can just feel the frustration from the administration. They were hoping to finish this up in January, and now it's here February, and maybe, they're really kind of cautioning this, too. They're cushioning it in. We're not done. Who knows? And, these things have broken down before.
And cynics will tell you maybe Benjamin Netanyahu is going to wait this out the way Vladimir Putin is until the U.S. election.
We had conflicting reports on this in the last 24 hours, really whipsawed crude. I think we got a break below 75 at one point on WTI. 2 hours away from the payrolls report. Let's go through the numbers for you. The median estimate in our Bloomberg survey looking for 185,000. The latest data following the Fed's meeting earlier this week. Here's a scheduling one for you. Fed Chair Jay Powell appearing on CBS's 60 Minutes on Sunday. The interview was taped yesterday, so you're not going to get his reaction to the jobs data. Lisa, I can always sense the frustration from the people who follow the Federal Reserve so closely, so I'm going to do this for them. Gina Smiley, the New York Times. Colby over at the Financial Times.
Yeah.
Mr. Leisman as well. Mike McKee. All of these guys, give them an interview with the Federal Reserve Chairman. 60 Minutes has its place, but it always feels like a tour guide interview to me. Just someone sort of guiding them through various issues without really getting that penetration, that deeper stuff out of the chairman.
He's not speaking to financial markets when he goes on CBS. He's talking to the American people, right? He's talking to the average person sitting in their living room. And I'm wondering if he's A, going to weigh in on politics, though he's not. He's trying to basically put his message out, maybe a defense, but B, to basically justify what he's doing as he comes under criticism in the financial media for being a little bit rogue in some of his statements.
Well, this is it. He's not sitting across from an expert witness that can actually follow up properly. And no disrespect to 60 Minutes, but they've got to be a jack of all trades across a whole range of issues. I just wish that I'd seen more from this Federal Reserve chair, sitting down with the people who actually have to report on the Federal Reserve every single day.
Hear, hear. I mean, I agree with you. I think that, again, though, it really raises the question of what's his purpose? It's not to clarify things for markets.
He clearly wants cover. I think, potentially, if they're going to cut rates this year, cover from, I think, one particular base in American politics. Also, remember during COVID, he went out and did an interview with the Today Show. He is truly trying to get into the homes of Americans, and he's not going to sit across from a John Farrow and get pestered on.
I'm not saying it's me. I'm saying it could be anyone that was in that news conference on Wednesday. Sunday, CBS, 60 Minutes. There's another plug for you. A range of calls from Wall Street for today's jobs report. Goldman coming in at the high end with 250,000. Sarah House and the team at Wells Fargo at 155K. Sarah House writing this. Although payroll growth has held up remarkably well recently, there are several signs of further moderation in the months ahead. Sarah, I'm pleased to say, joined us now. Sarah, great to catch up, as always. On the surface, it looks OK in payrolls, in the labour market in America. Sarah, where should we be concerned? Which spots in the labour market give you concern?
Yeah, I think there are a number of spots. So I think overall it's just the ongoing downward trend that we've seen in demand for new workers. So we can see that, for example, with the January hiring plans that came out for the NFIB yesterday that were at more than a 6-year low. We see that with the temporary employment declining for 11 straight months. And it's coming at a time when, sure, layoffs remain very low, but if you're not adding as many new workers, you need them to stay low in order to keep that net rate of hiring where it is. But already just in the past couple weeks, we're seeing those layoffs pick up a little bit. So I think that's one area of concern that suggests that you're going to get that further downshift in momentum, as well as some other things like just the overall mix of job growth, the negative momentum we're seeing in revisions as well that suggests that the 225,000 pace of job growth we saw last year just isn't sustainable. And we're looking for that to downshift pretty materially here in 2024.
Sarah, you talk about the composition of jobs, and we've been hearing a lot more about that. When you dig below the surface, where are these jobs actually being created? What's a warning sign for you in terms of where the jobs are being created and where they're not?
Yeah, so I think the fact that we've seen essentially 2/3 of job gains over the past 6 months has been in areas like healthcare and government. It suggests that the more cyclically sensitive areas of the economy, they are weakening pretty dramatically under the Fed's restrictive stance of policy. So if those industries can continue to hire at a good rate, that can keep us in positive territory. But I think it does suggest that there is more fragility when you are seeing those more cyclically sensitive parts of the economy weakening.
You know, we've been talking a lot about the anecdotes and how we hear company after company in earnings talk about how they're going to be doing layoffs potentially going forward. We hear about how efficiency really boosted the earnings of the likes of Meta and Amazon. How do you weigh that kind of information? Does that relate to the overall numbers, or are these just churns that happen as a result of technological shifts?
Well, right. I mean, I think we did see, firms take a really good hard look at productivity and what they could do to improve efficiency, particularly just given how difficult it was to hire workers over the past few years. And some of that's coming through and getting to their bottom lines in terms of their day-to-day business, and maybe even in some segments suggesting that maybe we don't need certain pockets as well. And so particularly as we think demand growth is going to slow overall, that could put some further pressure on headcount as we move through the year.
So I want to talk about price pressure as well. Stephen Stanley was with us around the table from Santander just yesterday. He said that the improvement in inflation over the last 6 months was down to one-off factors. He shared that fear that Chair Powell alluded to in the news conference. He thinks, in fact, that maybe we can stabilise at a higher level. Sarah, do you share those concerns? And what are those one-off factors?
Yeah, so I think over the past 6 months, we've certainly had some favorable things going to help bring that core PCE deflator on an annualized pace down so dramatically, so a little bit below 2% if you're looking at just the past 6 months. So things like you did get some declines in financial services given some of the price market action we had in the fall, so that was weighing on that component. You had some payback in areas like travel services, still seeing a pretty good correction going on in vehicle prices. So I think there are some questions about whether the downdraft we've seen from good prices, even energy prices more recently, can be sustained. But I think there's also been some better than expected news in there as well. So I've been pleased with the fact that you've seen that core services component really begin to roll over and at least not shift up in areas like medical care, which was one area of concern. So I think to some extent, the downdraft we've seen has been a little bit exaggerated, but at the same time, I think we are seeing signs that, at least on that services side, which the Fed's been very concerned about, that things are going well for them there.
Sarah, well, let's finish where we went to with Greg Barrell of BNP Paribas. Forgive me for asking this question again. How bad does the number need to be today to put a March rate cut back on the table?
Yeah, so I think if you got something probably closer to 100,000, I think that would really put it back in play. Of course, this isn't the only payroll report that we'll get before that March meeting, so we do have one more. But I think really in terms of putting March back in play, it is going to come down to actually seeing that weakening in the job market. If the labor market keeps chugging along for the next few months, I think you will see the expectations for March even reduce even lower.
Hey, Sarah, thank you. Sarah House of Wells Fargo, something around 100K, to Sarah's point. Plenty more data between now and then, but just putting that out there for you. Plenty of earnings after the close yesterday. Big tech this morning, the energy majors as well. Lisa, Chevron, Exxon, out in the last 20 minutes or so.
Yeah, basically having their second biggest annual profits in decades, just to give you a sense of how much they are earning, both beating across the board. Chevron talking about the Permian output and how much it's increasing that, talking about share repurchases as well as some dividends. Permian growth for Chevron is going to be maybe about 10% this year. Just want to make this note. We were talking about California and how Chevron's been really vocal about leaving California. Exxon said it's taking a $2.3 billion write-down, $2 billion of which is, quote, a result of regulatory obstacles in California that have prevented production and distribution assets from coming back online.
Easier to do business in California than Texas, which is what we've heard from the energy players, Mike Wirth, Chevron rather, and Exxon as well.
Yeah, easier in Texas than in California, which is the reason why they're shifting gears there. Here's the key question. How much are they going to address this directly on their calls, and how much is this really going to play into some of what they lobby for?
Let's get you a deeper update on some of those themes. We can get to the Bloomberg brief with Yahara Hakez. Hey, Yahara.
Hi, John. Intel shares are lower in pre-market trading on a report of delays to a $20 billion chip facility in Ohio. The plant was originally slated to begin production in 2025, but the Wall Street Journal reports it's unlikely to be ready until 2026. Intel declined to comment on the project's timeline, but said it remains committed to the effort. Visa says it blocked a record $40 billion in suspected fraud last year. The payments giant says criminal activity culminated in a boom around the holiday season, with blocked transactions up more than 450% year on year in December. Online fraud continues to grow as a major expense for banks and payment firms, with billions spent to try and stop it. And Bao Fan, the star Chinese banker who disappeared last year, has stepped down from his firm, China Renaissance Holdings. The chairman and CEO reportedly stepping down for, quote, health reasons and to spend more time on family affairs. The veteran dealmaker founded China Renaissance in 2005 and was detained by authorities as part of a broader crackdown on the financial sector. That's your Bloomberg brief. John?
Yahara, thank you. Just to clarify, much easier to do business in Texas than California. I can't believe those words came out of my mouth.
You know, I think that you just want the weather. It's kind of nice. Texas is a little too hot, I think, in the summertime.
That's not where I was going at all.
It's the Napa Valley wine.
I can't believe. Maybe I've been on the Napa Valley wine. Up next on this programme, bank stress back under the spotlight.
I'd say for the most part, everything's in the rearview mirror now. Things are starting to feel a lot more normal. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
That's coming up next on the program. Live from New York City, you're watching Bloomberg Surveillance. Equities on the S&P 500 positive here by 0.6%. In the bond market unchanged. Your 10-year 387.98. Nothing unchanged about this. Tech in the pre-market. Amazon, Meta flying. Meta's just absolutely ridiculous. We're talking about a $1 trillion name, up 17%. 17%. Lisa, it's ridiculous.
It's just, I mean, this is the thing, and it's sort of how much more can you actually rally after having an incredible rally last year, an incredible rally so far this year, and actually beating it and causing this further rally. So when people say tech is expensive, what exactly are they talking about, right? Where are those people when it actually comes to what they're delivering, and then who's buying on the day after?
Up 200% last year, up 12% so far year today, up another 17% this morning. So we're going to add to that rally for 2024. $50 billion buyback increase. Dividend over at Meta. I mean, take your pick. The numbers were just stellar across the board.
I mean, just the cash flow is just tremendous. What, $43 billion in the quarter when you look at free cash flow? I mean, this is sort of a joke. Again, it sort of does dovetail, though, into the jobs moment. Because these are companies that are able to make themselves very lean, and in doing so are able to capitalize on incredible advertising and the AI boom. And that, to me, really highlights how different they are than some other companies.
So true. The stock is up by 17% in early trading. Under surveillance this morning, bank stress back under the spotlight.
I'd say for the most part, everything's in the rearview mirror now. So there were a few idiosyncratic bank failures that related to the business model and how fast those banks grew. Things are starting to feel a lot more normal. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
Here's the latest this morning. New York Community Bank Corp hit with a series of downgrades a day after reporting a loss tied to deteriorating credit quality. The company also facing a potential credit downgrade from Moody's. Concerns spreading across the sector. The KBW Regional Banking Index heading for its worst week since June of last year. With us around the table, Herman Chan of Bloomberg Intelligence. Good morning, sir.
Good morning.
How bad is it? And is it just a single bank issue?
Look, going into the fourth quarter earnings reporting, the other regional banks that have spoken about the outlook for 2024 were pretty optimistic about the back half of the year with interest rate cuts, improving loan growth, and stabilizing net interest margins. And the comments about credit quality were actually pretty sanguine. So New York Community's reporting earlier in the week really upended the narrative and really brought the focus back to commercial real estate risks.
The problem is it wasn't just them. It was also Aozora over in Japan. It was also Deutsche Bank talking about some potential extra losses tied to commercial real estate. Meanwhile, you could see office space that's being left for dead because people don't have the money or the will to actually invest in it, and it's losing value at a dramatic pace. Anecdotally, things falling from, valuations of $200 million to $25 million in different places. How do you sort of say that that's all been priced in?
Yes, so we know that's a known risk that's coming down the pike over the next several years. The thing that sort of brings comfort to the banks, and when they talk about the risks involved with commercial real estate and office CRE in particular, is that they've underwritten pretty conservatively. So we're talking about loan to values around 50, 60%. And then on top of that, they built reserves over the past few quarters ahead of the potential losses that are coming.
People were saying this, though, back in March, because people were looking for the boogeyman and they're saying it's going to be in commercial real estate. And they still miss some of these. And I think that's what's getting people nervous, that even with all the things that you're saying, we've still missed some of this. How do we reconcile that?
We know there's going to be lumpiness ahead. So this is just an example of what's going to happen in 2024, 2025, 2026, where there's going to be lumpiness and charge-offs. And because these commercial and multifamily losses are a bit larger, they're going to create a bit of variability with respect to credit quality across the bank space.
More than $2.2 trillion of these commercial property loans due by 2027. So is it basically between now and 2027 that everyone's almost on eggshells?
That's right. So everybody's sort of knowing that the rolls are coming through, and there's going to be a few years of this happening and materializing. But again, when the banks talk about their criticized loans that have some sort of deficiency, those are increasing, but Citizens CEO mentioned the other day that that's flattening out. So that's great to see that they sort of have a handle on the potential risks that are coming.
Lisa, everyone says the same thing. You speak to a bank CEO and they say, our book's fine. It's everybody else. I understand there's some worries about the sector, but we've been very disciplined. We've heard that repeatedly all week.
And that's the reason why it just gives me a little bit of agita that you have this issue of these sort of surprises. I just wonder how much this is going to come out of the woodwork. And I'm not saying bank failure. There is a distinction between bank failure and this concept of constrained credit, as Mike Wilson was talking about, and more potholes. I mean, that's, to me, the issue.
Mike absolutely nailed it. You can draw a distinction between systemic risk and just profitability headwinds that's going to lead to tighter financial conditions because they're not going to finance the economy in quite the same way. Isn't that what we're staring down the barrel of now
for
2024?
So we've seen that happen last year after the failures of SVB and Signature and First Republic, where the banks pulled back on lending, were much more conservative with who they were lending to. And then on top of that, you saw a decline in demand because of where interest rates were. So that's starting to ease a bit, and banks are talking about being their loan diet by reducing their loans and increasing their capital ratios. A lot of that has been completed, so there's potential for loan growth in 2020.
The stats are pretty amazing. Commercial real estate loans account for 28.7% of the assets at small banks, 6.5% at bigger banks. It's another example of where we're looking at a problem, but not on the balance sheet of big banks, over on small banks. Yet every time we talk about regulation, we're talking about how to regulate larger financial institutions. Why do we keep doing that?
Yeah, I agree with you there. And I think the CEOs of the biggest banks will say that their capital ratios, their liquidity ratios are much more gold-plated versus the rest of the industry. And the risks are really in some of the smaller players at this juncture.
So not to be conspiracy theorist, but some people speculate that small banks and large banks are asking people to come back to the office full time because they want to support office valuations. Is there credence in that? Do you find that that in general banks are having their staff come back to work 5 days a week?
You're seeing that across the board.
Is it because of that, or is it because of just efficiency and that it doesn't work when people are
I'm sure it's mostly efficiency, but it can't hurt if you have folks coming in more and propping up the values of office CRE.
Herman Chan of Bloomberg Intelligence. Bramo, get back to work. It's going to solve everything. Get back into the office.
Well, I mean, right? I just wonder, come on, how many times have you heard that? Of course that they want everyone to come back to the office 5 days a week. It's going to support the valuations. I think that there have been, and I've had conversations.
Actually, I haven't heard that, but it's kind of funny. So I appreciate
The
it.
best part of that is I don't want to be conspiracy theorist, but.
Well, I mean, I've heard that quite a bit. I will just say, look, I do think, though, if you talk to people in private, they feel like people weren't quite as efficient at his home. So they'd like people to come in, and that's the reason why.
I think managers feel like they've got tons of work done at home. I think what this is really about is the entry-level people have come up into, let's say, a financial institution and can't really learn the trade without having the management around them. Isn't that what this has always been about?
That's a big part of it. But I think that there also is something where people get sort of disassociated when they're working from home.
You're going to give me the culture thing?
I didn't want to use the C word because I knew you would just...
You're going to give me the culture thing?
No, I'm not going to give you the culture thing. I just, you have friendships, and if you have...
Family?
I'm not saying family. I'm just saying that typically it's harder to feel connected in the same kind of way to a company if you're at home doing your own thing. You're looking at me. I'm not going to say the C word.
Culture. The culture thing drives me nuts.
But it's not, but you see this, right? I mean, how many studies have we seen recently? I'm going to go straight to studies.
Sure.
Where basically people who work from home more of the time are more likely to get laid off because they don't have those connections with people.
They feel disconnected from the company culture. I think it's really important.
I didn't say disconnected from the company culture. It's like they don't have friends.
Mentors. They don't seek out their mentors
Friends,
of your
apparently.
younger generation.
Either. Herman, thank you, sir. Herman Chan at Bloomberg Intelligence. Everyone working from home today, Bramo thinks you have no friends.
No,
Coming up on the next hour, Priya Misra of JP Morgan, Ellen Zentner of Morgan Stanley, Connecticut Governor Ned Lamont and Mandeep Singh of Bloomberg Intelligence. Live from New York City on this Payrolls Friday. Here's the estimate for you in our survey here at Bloomberg. We're looking for 185,000. That's the median estimate in our survey. The previous read was 216. Equity futures are positive 0.6%. Thanks to Meta, which is absolutely flying in the pre-market, higher by more than 17%. From New York, this is Bloomberg.
The underlying inflation piece is not as good, I think, as the numbers would suggest.
For the Fed, it makes sense to err on the side of caution.
He was appropriately cautious. I think he wants to push out the notion that the next cut is in March.
If inflation moves in the right direction, they'll be able to start normalizing.
The Fed's under no pressure to cut rates. It is under pressure to make a big decision in March.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
That moment when you insult people working from home and your manager's working from home. How's that working out, Bramo?
All right, let me just be really clear. I'm just saying that there is something about being home. If you are working from home, you have friends, you have a great life. I am jealous of you because it is a Friday. And
Our
it's
manager
a great
has
time
friends.
to be working from home.
It's pure envy. Well done, Bramo. From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity's doing okay in a pre-market. We're doing better than okay if your name is Meta and Mark Zuckerberg. We're higher by 17% in early trading, a $1 trillion name. Up in the pre-market, Lisa, 17 percentage points.
Again, it's bonkers that a $1 trillion market cap company is trading like a penny stock after reporting earnings that also are equally bonkers in terms of cash flow. $43 billion in free cash flow. Talking about a company that's generating above and beyond after all of the high expectations and all of the gains on efficiency, on Meta, and also just frankly on advertising.
Not like it's coming off a bad year either.
Exactly.
It was up 200%. Last year. Let's bring up Apple. Take a look at Apple in the pre-market. That's lower. It's negative by something like 2 to 3% this morning, following some pretty meh numbers from that company. The good news is they avoided posting a fifth straight quarter of declines. That's kind of where the good news ends. AMH China, down $3 billion, down 13%. Not great at all.
The bar was so low in terms of the quarter, but John, 13% decline in China sales. The question is, how pervasive is this for Apple in China? Where's the weakness going to continue to come, especially as we see more people go for Huawei, which they get the same kind of access to a hardware, but it's much cheaper on the price point?
Yeah, this is the right question. Is it competition? Is it foreign exchange? Is it nationalism? And will it last? Because this is a very important market to this company.
And can Apple address any of those issues? Because frankly, all of them are out of their control and they're tied to a nation that is incredibly fickle with respect to this particular technology. Honestly, the answer is competition. The answer is not nationalism. FX, no one really cares. So they're going to have to really address that on the
We're down 2.6% in the pre-market. Equity market's still doing okay. Need to talk about payrolls. 185 is the median estimate in our survey. The previous read, 216. We're about 90 minutes away. We've talked about it a few times already this morning. What would it take to reintroduce, put back on the table, a March rate cut? And we had an answer from Sarah House of Wells Fargo who said something around 100,000 would get that conversation going.
And especially if it's accompanied by weaker under-the-hood kinds of composition. I am curious about wage gains. No one seems to be talking about wage growth, but we're expecting 4.1% wage growth year over year. I just wonder if that's good enough to get it done, right? If that's good enough for the Fed, or if it needs to come in and an unexpectedly sort of weak job growth.
This is how the stage is set going into the numbers. Equities look like this on the S&P 500. We are firmer here following decent numbers from Amazon, from Meta. The stock market is up by 0.6%. Bond yields are unchanged, 388.17 on a US 10-year. Coming up through the hour on this programme, Ellen Zettner of Morgan Stanley looking ahead to that payrolls report. Connecticut Governor Ned Lamont on the salt tax deduction bill making its way through the House. Mandeep Singh of Bloomberg Intelligence on the growing divide in the Magnificent Seven, and you can see that divide front and centre this morning. We begin with our top story, the US jobs report, just under 90 minutes away. A range of views on the street. Goldman coming in at the high end, expecting the economy to add 250,000 jobs. JP Morgan something like 225. Wells Fargo calling for 155. Priya Misra with us around the table, portfolio manager at JP Morgan Asset Management. Priya, good morning.
Morning.
Reaction function of the Fed. Do they embrace strong numbers and maybe move closer to cutting rates if we get a weak one?
I think they told us they just want more confidence that inflation is heading lower. So I actually think the reaction function, I'm glad you bring that up, because that's really what we hear on Fed Day. I think the reaction function is much more on inflation rather than growth. So I think if that wage number today is a little weaker or any sort of revisions, I think that actually inches them towards March. I know he pushed back. I know Chair Powell pushed back against March. but it's because he said the first cut is consequential. He didn't push back on the reason to cut. He didn't push back on total amount of cuts. So the market should go beyond, it's March or May. It really doesn't matter. It's a few months among friends. But it's about the total amount. And the Fed, I think, did not really push back on the need to cut. So I think just even a 200 and a 0.3 on average hourly earnings is enough for them to keep March on the table. There's a lot. There's CPI revisions. There's also payroll revisions. And I think the Fed tells you they look at all of that data.
You mentioned this a few times now. How important are those CPI revisions that I think come a little bit later this month?
It's extremely important. I mean, we heard from Chair Powell. He sounded disappointed with them because he said last year was a surprise. Governor Waller brought it up. I think this Fed, that's a data-dependent Fed, and I know the market never pays that much attention to revisions, but it's extremely important. We've had negative revisions all last year. We have another set of revisions today. I think if the revisions are weak, that actually gives the Fed that confidence. Start the normalizing. You're not really easing. We're going from very high positive real rates lower. So I think revisions are important for the Fed. The market, I think, still has to do some work to pay attention to it.
We learned a lot from the press conference, just in part based on the bias toward cutting rates, and no way are they going to be hiking rates. And that's important because when we say data dependent, what are we talking about? Because there's data to show anything. Yesterday, we saw ISM manufacturing coming in much stronger than expected, with prices paid surging the most since December of 2020. Where do you place that in the sort of immaculate disinflation that everyone's embracing?
Right, and immaculate disinflation, I'm glad you bring this up, is key to that soft landing and key to the reason why the Fed is easing. So I think the goods disinflation or deflation that we've seen, I think the Fed thinks that's done. And that's why I took less out of that ISM manufacturing, because that's goods inflation, goods deflation. I think now the focus is on wages and the focus is on service inflation. That's why that rent inflation number is that important. As long as that, and we're going to get the CPI in 2 weeks and we're going to get CPI revisions, as long as the service inflation continues to head lower, I think the Fed might look through. The good news is over on the supply chain front, on the goods front. And actually, even if that goes up, but wages are coming down and service inflation is coming down, I think the Fed's going to say, well, goods inflation is actually cost push inflation. It's bad inflation. And I think their confidence, I think, is much more on, or they need more confidence on service inflation.
You're talking about CPI revisions and wage inflation. Is the wage number in today's data more important in some ways than the headline number?
I think so. And, to be realistic, I mean, the standard error around non-farm payroll is 100,000 on either side. So actually, it could be anywhere from 100 to 300, and we should not really take it seriously. I think that wages number is more important. Chair Powell didn't really push back on cuts because the economy is strong. I think they realize, yes, the economy is strong, but it's all about inflation. So I think wages are actually more important.
A single bank moved this market more than Chairman Powell. I think we should probably talk about that a little bit. You've become constructive on credit. Anything give you pause after what's happened this week?
So what this week tells me is active management, making sure, it's a lot of work, understanding business models, understanding charge-offs, how much provisions are put. That is so important. It's the guts of what we do in active management. It actually reinforces why you have to continue to do that. It's easy to say whether do I like banks or not, but there's going to be winners and losers, or I guess losers and more losers in terms of commercial real estate. Just making sure you know what you're buying. I still think if the soft landing, and this is key, can the Fed cut early enough, cut enough to get that soft landing? In a soft landing, I think you're supposed to be in credit. You just have to be really careful, diversify the portfolio, make sure you know what you're buying. And I always think where there is a systemic problem with commercial real estate. If there's one bank, there are going to be more banks. So I think we'll all be looking under the hood, and we have been. Who has that exposure? Who has capital? Remember, what the Fed helped last year was funding. They actually didn't help capital. So we're looking carefully at which are the banks that are building capital, because that's ultimately what you need against these losses that are sitting on bank balance sheets.
You said earlier, what's a couple of months amongst friends? What's a couple of months amongst the two frontrunners for the election? Trump this morning saying he's not going to reappoint Powell because he's going to do something to help the Democrats if he lowers interest rates. Does the timeline matter for you?
I think Chair Powell's been talking about cutting rates. The Fed overall there's actually a remarkable amount of consensus at the Fed. And I wonder if the statement this week where, they're trying to have their cake and eat it too. Well, we're ready to cut rates, but we are extremely inflation, we are focused on our inflation target. Is that a way to keep that consensus? So I actually think it's not Chair Powell versus a bunch of other Fed officials who don't think we should cut. I think they're trying to push back against being viewed, that they are politicized. They will be dragged into the election. They were 4 years ago. They still will be. But I think the timing, they've set the market up. And so whether it's March or May or June, I think it's in that time frame that we expect the first cut. And I think they're trying very hard not to be viewed politically.
So then why is Jay Powell going on 60 Minutes to talk about his feelings?
I think he needs to explain to the market. It's a really tricky environment. The economy is strong, risk assets are doing well, and the Fed's cutting rates. So explain to, I'm sure everyone watches Bloomberg, but explain to people who may not be watching, you all, that there's a normalization aspect to it. And it's hard. I think in that press conference, he can't really shape the narrative. He has to answer questions. I think here he can and say, look, we're not easing. We're not helping stocks go up more. We're just trying to keep that soft landing going. I think just get that message across of normalization.
Therapy on CPS. Is that what you're saying?
Well, no, he's clearly got a different audience. So what's the message and why now? Because to me, this is sort of an interesting moment where he's under a lot of political criticism. He's saying he's not political, but he's trying to speak to the people. He's not speaking to the financial media.
I think he's looking for cover because he knows he's going to cut and he's going to get dragged in, as you say, Priya, to this political mess. So he's looking for cover for maybe some members of the Republican Party to not make this as political as it should be. He's saying it is about the economics. It is about the data.
We're talking about the Republican Party. What about the Democrats? It was the Democrats that sent him letters. Never mind the former President Donald Trump.
Right.
He's not even in power. Let's talk about people in power in Congress that have been totally inappropriate, sending him letters right before a big decision, the first decision of 2024.
Again, it sort of goes to why he's probably trying to speak to the people. He's saying, I'm not reading the letters. I mean, really, I'm curious if they're going to ask him, if 60 Minutes is going to ask him, do you open those letters? Where do you put them? How do you feel when you read them? What's your first reaction?
In the shredder, hopefully, where they belong.
Well, yeah, but it would be interesting to get that kind of pushback.
Yeah. Priya, it's good to see you. Great to catch up. Priya Misra, JP Morgan Asset Management. Looking forward to Chairman Powell. 60 Minutes, CPS, to talk about what? His feelings. Nice.
I think he's going to put a message out there. I think it's going to be an important message for him to get out there because disinflation is a very complicated concept.
Agreed. Super complex. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Russia struck central Ukraine with drones in an attack that hit a power substation, according to a Telegram post from the grid operator. According to local authorities, over 40,000 households and 2 mining operations lost power, initially stranding over 100 miners underground. The strike follows a series of attacks in the past weeks targeting critical infrastructure in Ukraine. Chevron is higher in pre-market trading after the company beat earnings forecast for the first time in 3 quarters, fueled by strength in trading and production. Adjusted fourth quarter earnings of $2.48 a share were higher than analysts expected. Output from key fields in Guyana and the U.S. Permian Basin expanded while the company's refineries processed more crude than ever before. Meta CEO Mark Zuckerberg stands to receive a payout of about $700 million a year from the social media giant's first ever dividend. He's already the 5th richest person in the world, according to the Bloomberg Billionaires Index. The payout will be a nice boost to the $27 million he took home in 2022. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the data-dependent Federal Reserve.
If the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed.
That conversation continues. Your payrolls report is just around the corner, live from New York City. This is Bloomberg. Live from New York City, it's Payrolls Friday. That number is just around the corner. Ahead of that, equity futures look like this on the S&P 500. We're positive by 0.6%. Bond yields lower by almost a basis point. The 10-year 387.61. Under surveillance this morning, the data-dependent Fed.
If the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed. So for me, I'm looking at the unemployment rate. Does the unemployment rate back up significantly? We've been in that 3.5% to 4% range. I think we'll eventually get above 4% this year, but it's going to come in the back half of the year, not in the first half.
Here's the latest this morning. The January payrolls report coming up in the next hour. The median estimate in Bloomberg's survey calling for an unemployment rate of 3.8%, an increase of 185,000 jobs. Ellen Zentner and the team at Morgan Stanley calling for a print of 215. Writing this, we expect widespread gains in payrolls with particular strength in construction because of warm weather and a rebound in couriers after an outsized decline in December. Ellen Zentner joins us now for more. Morning, Ellen.
Hey, good
Are we
morning.
looking for a re-acceleration then, a pickup in this jobs market?
Well, I think not necessarily a re-acceleration, just continued strength. And I know the teaser that you gave, it sounds odd to say that construction will be up because of warm weather. Didn't January feel like hell? But it was really warm in the first half of the month.
True.
And that captures the payroll survey week. And so we did create jobs, weather-sensitive jobs during that time.
There's been some concerns about the breadth of jobs gains. How many sectors are supporting this jobs growth? Do you share that concern?
Yeah, I mean, job growth is narrowing. And just as with the stock market, we'd like to see breadth. It means durability, stability. But you don't say that the jobs we're creating are not valid because we are short jobs needed still in services, places like services, where we are creating a lot of jobs, where immigration numbers are helping there as well. So I do think that this is a labor market that continues to be healthy. There's no data there that says we are headed toward a cliff or we're going to have a sudden shift in growth.
How long can we have a healthy labor market and disinflation and the idea of wages continuing to grow at a slower pace?
Yeah, so look, the Fed is pretty comfortable with wage measures now. Even as whether you look at the employment cost index measures or the average hourly earnings coming down close to 4%, if you think about productivity plus inflation as sort of a rule of thumb in terms of what would a normal wage growth be, we're in that range. So there's no concerns there. And wage pressures on the way up weren't contributing to inflation. They're not going to contribute to disinflation on the way down. What is a decision for companies, and we are seeing play out in the data, is that even though wage growth is slowing, it still means labor costs are rising. And they're rising as a share of corporate income. And so what are we seeing? If you look at the transcripts from earnings season, companies are doing capital deepening. They are spending more, and you're getting those big productivity gains like we just saw reported for the fourth quarter.
Help me understand how you deal with things like what Mark Zuckerberg said yesterday of Meta, Facebook. I've really come around to thinking that we operate better as a leaner company. And he was responding to calls for potentially boosting some of the staffing and some of the infrastructure of his company. How do you view some of the focus on being lean and efficiency with AI and the churn in the labor market? How do you translate that into an understanding of whether things are healthy or not?
Well, I think that one of the big concerns around AI, or anytime we've had big changes in technological advancements, is what does that mean about labor? Who's losing their jobs? Because ultimately, longer run, it's a very positive development for the economy, but we kind of gloss over that there's a temporal effect where people do lose their jobs. Companies, like you mentioned, right, are saying, no, we're going to lean into that and add jobs. But there are going to be certain sectors, healthcare, education, that are going to really be impacted by AI. And we'll have shrinkage in labor over that time as it's being adopted. But we're not in sort of the Elon Musk camp that said, that's fine. Why would any of us need to work at all? Let's all not work and we'll all just lay around like in the movie Wall-E, right? And so we're in the camp of that technological advancement, especially in AI, will eventually expand labor and expand other areas where we can grow and see greater productivity.
Or the Jamie Dimon camp of 3.5 work days. I'm not sure if you're in that one. But when you look at some of these job losses we've seen, it's everywhere. It's banks, it's in some of the tech space, it's Levi's, it's UPS. Where do you see potentially the rest of the year sectors that could be in?
Yeah, so look, I think we can always point to sectors that are doing headcount adjustments, full on laying off, however we want to call it. But broadly speaking, and I think to me what's important is that the transcripts broadly across earnings still show this, is that companies overall are retaining workers but not doing broad-based layoffs. So we can point to spots where they have overhired and are adjusting, and tech and fintech, a big area there. But companies are still feeling the distortions from COVID, where it took them so long to hire, and they are running lean headcounts. And so they're going to hang on to those so that in the next upswing in the economy, they are prepared to respond to that. Now, that sentiment can shift quickly. And so it's why watching weekly jobless claims is very important, following what companies are saying. Look, this is one of the greatest areas of AI, is that it's helping us with these large language models really stay on top of quickly any kind of shift in sentiment. And that can really change the outlook on a dime.
Let's turn to inflation and the Federal Reserve. You put out a piece, I think about a week or so ago, about a non-committal Chairman Powell at this meeting because of revisions on CPI. Can you walk us through how important these revisions on inflation are going to be?
Yeah, so on February 9th, we get revisions to CPI. It revises the data series. Think about what we're expecting later today with payrolls, right? We've been forecasting a number that's based on data that's about to change. Okay, so anytime there's revisions, it creates a lot of uncertainty. Now, historically, we went back 27 years, the revisions tend to be very small for CPI. But last year, the revisions, the Chair Powell for the first time said that there was welcome news on inflation. And then we got the revisions, and it revised up CPI by 120 basis points. So all of a sudden, inflation was 1.2% higher than we thought. And then you got 2 CPI prints after that that surprised to the upside. So it was just a complete game changer for the Fed that thought they were coming toward the end, drifting toward the end of the hiking cycle. And so we don't expect this to be a big number. We think that that was a big adjustment. We'll be back to something within historical range. But the Fed doesn't know, right? And when there's uncertainty at the Fed, it creates policy paralysis. It's very difficult to get consensus on starting cuts soon when you have not seen the full scale of data yet.
Which raises the question, and we keep asking it, and I'm sorry, but we're going to have to ask you too. How high is the bar to sort of change it to march on the table? In other words, how low do jobs have to be today to really get it back into the picture?
So instead of focusing on today, I would say, okay, the 2 jobs reports that we get before March, I think an average of 50,000 over those 2 months, I think coupled with very tame inflation that continues to point to inflation staying as low as it is right now, that could do it. But it's going to take very convincing data because, as you said, Powell just raised the bar extremely high. I was in my office listening to the Q&A, and as soon as he said, I think it's unlikely that my colleagues are going to come to an agreement on March, I yelled, boom! and the team, we were cheering, of course, because we've had a call for June for some time. And so, but I've been covering the Fed for 25 years. That was a moment of clarity that you don't get very often.
True.
And he wouldn't say that unless they really did take a straw poll in the room, and there was not a lot of support for March at all.
I imagine the teams at Goldman, BofA and Barclays didn't all shout boom when he did that because they had March calls, Bramo.
No, the boom was falling out of their chair.
Well, and then they promptly changed them. But I wonder, do you think it was a mistake on his part?
No, I don't think so at all. Because I'm not forecasting a policy mistake. I forecast that I think the Fed does the right thing and what I think that they should do, and that's June. Now, I think I can be wrong, right? We have to recognize that we can all be wrong in calls. Tongue-in-cheek, I say they hit the floor when he said March, right? But we're all wrong all the time. And it could come earlier. It could come in May. I think that they do have to revise downward their inflation forecast at the March meeting, and that could be an easy setup to signal for May. If they say soon could be appropriate to adjust policy, the soon could be appropriate means they're doing it at the very next meeting.
Ellen, it's good to see you. Ellen Zender of Morgan Stanley on this Payrolls Friday, looking for 215,000 payrolls 1 hour and about 5 minutes away. Coming up next, Governor Ned Lamont of Connecticut. He's going to join us around the table. Let's look at the price action together, Bramo. Equity futures right now bouncing back. It's down to a couple of names. Meta, Amazon, absolutely surging in the pre-market.
Let's take a look at Meta right now. It was up about 17% on a $1 trillion market cap, now 17.7% rounded up. This is what we're talking about. $1 trillion stock trading like a penny stock.
Bob Iger's Walt Disney added to the market cap of Meta this morning, which is just...
boom.
Boom.
There you go.
Boom is the right word. Equities on the S&P 500 positive here by 0.7%, on the Nasdaq higher, even with Apple lower in the pre-market. We're firmer by more than 1 full percentage point on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Going into payrolls, that data 1 hour away. 185,000 is the median estimate in our survey. The 2-year yield higher by 3 basis points. The 2-year 4.23. The 10-year 387.42. Just to finish on foreign exchange, the euro against the dollar not doing much at all. The euro right now 108.82, positive by 0.1%. I can read your mind, Bramo. What's new?
Shocker! Wow, exciting.
Currency pair not doing much at all. This is exciting. Big tech under surveillance this morning. Amazon, Meta absolutely flying in the pre-market after posting blockbuster earnings. Meta issuing its first ever quarterly dividend and an extra $50 billion share buyback. Apple shares falling after it reported a 13% drop in sales in China. So here are the moves. We're down 2.7% on Apple. Meta up by almost 18% in early trading.
I mean, it's just bonkers. I mean, it's just crazy to think about how much market capitalization is being created. They have $50 billion of an increase to their share buyback authorization plan, and then they gain almost $200 billion in market capitalization overnight. Here's a question. How much further can this go? Can people still talk about this sector as being expensive if it seems like, despite the incredible gains last year, the incredible gains early this year, you could still eke out a mere 17%?
It's the lesson of holding on to your winners, isn't it? Up 200% last year.
It's just, I mean, again, it's sort of, people say the bar is really high, and then they raise it even higher.
Yeah.
And so at this point, how do you get away from the Magnificent Seven or the Magnificent Five, if you want to kick a few out, if you really do want that profit growth?
It's impressive. We're not even talking about Amazon, and those numbers were pretty decent as well. That's the story for big tech. Let's talk about the Middle East just briefly. US forces fending off 2 attacks on the coast of Yemen as the conflict with Houthi militants continues despite repeated US and UK military strikes. Central Command reporting forces shot down a drone off Yemen's south coast before destroying an unmanned vessel stocked with explosives in the Red Sea. Annmarie, still waiting for that response from this administration.
Yeah, we are waiting for that response, but they have been telegraphing it. And Lloyd Austin was asked about this yesterday. Why are you telegraphing this so much? CBS has a report that they're going to go after Iranian officials or facilities in Syria or in Iraq. Aren't you giving them the upper hand to prepare for this? He said he wouldn't comment on that speculation, but they did say it was going to be a multi-tiered response. But this one regarding the Houthis, Jonathan, felt very preventative, more than the reactionary we have been seeing from this administration.
One to watch going into the weekend. This is one to watch going into the opening bout a little bit later. The fallout from New York Community Bank continues. A number of firms downgrading the lender and Moody's putting it on review for a credit rating cut. Concerns spreading through the regional bank sector. That KBW index down more than 8% over the past 3 days. In Japan, one bank there plunging for a second straight day after saying it would have its first loss in 15 years due to bad loans tied to, guess what, Lisa? U.S. property.
It's a known issue, and yet the fact that everybody knows it and still you're getting these losses really highlights that. I just want to point out, I've been getting a lot of hate mail about working from home and how it's really a good thing for the environment and it's a good thing for families and it's a good thing. They do have friends. I understand that. I'm just saying that there is this question around office space and the future of places that do not have investments, that don't have owners that are willing to really put anything into them, and they're being left for dead and they're being written down to zero. So this is sort of a question. How do you sort of deal with this space? And that's why some people are, looking into this more closely.
OK, good. Are you finished on the return to work stuff and working from home?
For now.
OK, good. With us around the table, I'm pleased to say, is Connecticut Governor Ned Lamont, who's got things to say about getting back to the office and getting back to work.
I want to hear what he has to say.
I'm sure. Governor, good morning to you.
Jonathan, good day.
We're not going to start there. Don't worry about that. We're going to start here. There's this big story about people fleeing blue states and going to red states, and we know those red states. And you've got a different story to tell. You're saying it's different for Connecticut. Why is it different?
Yeah, the Wall Street Journal keeps saying, boy, everybody's fleeing those blue states. They're raising taxes. That's why they're all leaving. Just the opposite in Connecticut. We've had probably 50, 60, 70,000 people move into the state over the last few years. We did cut taxes. I think that's one of the reasons. But also, we kept things open during COVID. Our schools stayed open. People looked at our suburban lifestyle, saw our cities coming back. A lot of young people moving in the state. We want you. Come on back.
You said last time you were at Bloomberg, if New York catches a sneezes, we catch a cold in Connecticut. How are you dealing with the migrant crisis that we do see New York dealing with right now? Are you seeing an overflow into Connecticut?
We're seeing some overflow. Certainly, we're not being overrun like unfortunately, I see what's happening in New York City. I talked to Eric. I talked to Kathy quite a bit. You know, we've got our folks standing by. We're getting, motels and places, nursing homes that we had retrofitted during COVID to get people off the street. You know, we're ready, but still, thankfully, we've got things able to take care of people.
Do you need more support from the federal government?
I do. I mean, I agree with the Democratic governor, say we need more support from the federal government. I think especially true here in New York City. But also, we got to secure the border. We got to be a lot stricter on the border. You've got to do both.
We've been hearing from this administration about what they can do going it alone. President Biden has talked about possibly closing the border. Are you hoping he does that?
I am. Look, I call the Republicans bluff. They're saying, President Biden, you're not willing to close the border. Give me the tools to do it, and I will do it. I can't figure out why they're pulling back now, saying it's not that much of an emergency. We'll wait till after the next election. I think that's the wrong move. Let's make the deal.
You've managed to cut taxes, and you are in the black. New York is not, in large part because of this issue. I'm just wondering, at what point does it challenge your being in the black to be able to cut taxes and also deal with a pretty dramatic influx of new people?
Look, my heart goes out to Eric Adams. I mean, this is costing the city, $4 billion plus per year right now? You know, at the same time, your capital gains revenue is going down, so it's hitting the city pretty hard. And to your point, we cheer on New York City. We are part of the New York City ecosystem. Everybody thinks we're sort of frenemies and competitive. You do well, we do well.
It's amazing to hear Democrats start to sound like Republicans on this issue. You and I talked about this before. Do you get the sense that Democrats have been robbed by reality on this issue? That we had this big issue down at the southern border for a long time. And yet here we are now. We need to confront it in blue states, New York, Connecticut, and elsewhere. And all of a sudden it's a problem we need to fix. Why wasn't it a problem we need to fix before? And why have we been robbed by reality now?
Yeah, mugged by reality.
Forgive me. Robbed, mugged, same thing.
Same idea.
You're in New York.
I pull the lens back for just 1 second. We have the most successful economy on earth. People know it. That's why more people want to come to this country than ever before.
Without a doubt.
But you're absolutely right. It only works if we secure our borders. Maybe Democrats were a little slow to get up to speed on this. Some of us, from this part of the region, we weren't hit as hard early on. I think we all know where we got to be now. That's why it's so important the Republicans don't pull back at this last moment. The ball's on the 5-yard line. That's a football analogy. And, real football.
Real football. You want to go there now? Governor, I thought we were friends. Governor, I thought we were friends.
Let's get it into the end zone just to keep you confused and see if we can get this done. Then hold the president accountable. You got the tools to do it.
How confused do you think the president is on this issue, and how much distance is there between him and you?
I don't think there's any distance right now. He's come out strong. He said, give me the tools. I will shut down the border to illegal immigration. He was very clear on that. Maybe you wish he'd said that sooner. He's saying it now. The ball's in Congress's court. You're going to give him the tools to get the job done.
But, Governor, was he clear on day one? On day one, he paused nearly all deportations. People say this was a signal to many countries that it is going to be easier to get into the United States now than it was under former President Trump. Was that a mistake?
People have been trying to come through our border for years. I mean, under Trump, and remember during the midterms, he'd been there for 2 years. He kept talking about caravans of terrorists coming up to our border. So it wasn't like everything was peaches and cream 6 years ago and then it changed. I think we're serious now. I think there should be strong bipartisan support. Our Senator Chris Murphy is helping to lead those negotiations. Let's get it done, hopefully as soon as this weekend.
I think the reason why we're all talking about immigration and migrants is because in our poll, it's starting to show that that's becoming more of a top issue for voters in 7 swing states, which right now, former President Trump is leading Biden. How concerned are you about President Biden being able to win re-election in November?
I think at the end of the day, after we've exhausted all other alternatives, we go for the sane course. I think that will be President Biden. But I think you're right. I think immigration is a very big issue. People think it's about age. I think he gets immigration right. Congress gives him the tools to get it right. We're going to secure the border and people feel a lot better.
What do you think of individuals like Representative Dean Phillips? He's not even saying so much that he's running to be president. He's running to give people an option. Should there be more options, given the fact that poll after poll continues to show that Americans think President Biden is too old?
Dean who?
Dean Phillips.
I
I know you know who that is.
Yeah, that's fine. I think in a
him.
primary process, I think a lot of options are good. I like a lot of different voices. At some point, you got to consolidate around who you think are the most reasonable choices who can get elected, decide who will make a difference on your behalf.
Not to shift gears completely, but I do want to finish up on the work from home question. And I know. Okay, but this is actually really important to you because I imagine a lot of people working from home were able to move to Connecticut away from the city. And I'm just wondering, as people do go back to offices, do you think that inward migration is going to slow?
No, I think it's changed forever. I really do. Our rail service is such that we are picking up more people coming in and out of New York and Fairfield County. Fridays are empty. TGIF has a whole new meeting. Nobody goes. Thursday is now party night.
You know it's Friday.
Except for you.
Thanks.
God bless you. So I think for Connecticut, that means a lot more people say, hey, I can have a lifestyle out in Connecticut, really great schools, live in a home. If I have to go to New York City, great place to visit, wouldn't want to live there. They come in maybe 1 or 2 days a week. And I think that's a lifestyle that works for people.
I hope Kathy's not listening this morning.
Hey, Kathy.
Governor, it's good to see you. As
Nice
always,
to see
great
you
to
guys.
catch up. Thank you, buddy. Governor Ned Lamont there. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. North Korea fired multiple cruise missiles off its west coast in its fourth launch in some 2 weeks. The move came just hours after Kim Jong-un called to step up war preparations during a visit to a naval shipyard. Kim was on hand last month to see the test of a new cruise missile that can be launched from underwater and inspected a nuclear-powered submarine the state is trying to build. Billionaire investor Nelson Peltz has formalized his pitch to Disney in a long-awaited letter to shareholders. In the letter, Peltz questions the company's planned investments in its parks and cruises division and suggests bundling streaming platform ESPN Plus with a service such as Netflix. In response, Disney's board says Peltz brings no media experience and has presented no strategic vision for Disney. Peltz owns around $3 billion in Disney stock. New York hotspot Carbone is set to open a restaurant in London. The high-end Italian restaurant plans to occupy a ground floor space in the former U.S. Embassy building in London's Grosvenor Square. Carbone currently has restaurants in Hong Kong, Doha, and Paris, but this will be its first in the UK. That's your Bloomberg Brief. John?
Yahara, thank you. AMH has thoughts on Carbone in London.
What a magnificent piece of real estate, though. Dead center of London. The former U.S. Embassy there is wonderful. Remember, former president said the new embassy they're opening up is a lousy location. He loved the location of the former U.S. Embassy. I have to tend to agree. It's a fantastic spot. John, you know this.
You ever been to Carbone?
Once, in Miami.
I've never been to Carbone. I'm happy to say.
Only because they do gluten-free pasta, I was willing to go.
Oh, they did? They lost their star, though, right? Their Michelin star.
Because of the gluten-free pasta. Sorry, carry on.
Because of gluten-free pasta. No. You know what? The Italians are actually very, very good at addressing that need.
Oh, it's
that
because
requirement,
a lot
yeah.
of Italians have celiac or celiac.
There we go. Up next, learn something new every day, Bramo.
Indeed.
Meta's magnificent year.
2023 was our year of efficiency, which focused on making Meta a stronger technology company and improving our business.
That was Mark Zuckerberg of Meta. Much more on that in just a moment. Live from New York City, this is Bloomberg. Live from New York City, counting you down to payrolls. That report about 45 minutes away. Equities right now on the S&P 500 positive by 0.7%. Bonds not doing much. Yields unchanged, 388.17 on the week on a two-year, Bramo. It's quite a move on a two-year so far this week, down by around about 15 basis points coming into today's session.
Even with Jay Powell taking March all but off the table, basically the boom moment that Ellen Zentner talked about, where he actually said something definitive, that it was unlikely that March was going to be the time that they started with rate cuts.
The boom moment was yesterday afternoon when Meta earnings dropped. Under surveillance this morning, a magnificent year.
2023 was our year of efficiency, which focused on making Meta a stronger technology company and improving our business to give us the stability to deliver our ambitious long-term vision for AI and the metaverse. I think that being a leaner company is helping us execute better and faster, and we will continue to carry these values forward as a permanent part of how we operate.
Here's the latest this morning. Meta cutting 22% of its headcount in 2023, and it's paying off. The company posting a 25% gain in sales, announcing a $50 billion share buyback and issuing its first ever quarterly dividend. A blockbuster earnings report, but Mandeep Singh of Bloomberg Intelligence warning top-line comparisons are likely to get tougher in the second half as the company likely saw tailwinds from a cyclical rebound in advertising spending and improved ad attribution and measurement. Mandeep Singh joins us now for more. Mandeep, let's go straight to it. How do you cut your staff that much and grow that much at the same time? How impressed are you?
I mean, that's where, a founder-led team can always out-execute you. And Mark Zuckerberg has shown time and again that they are the most nimble product team when it comes to shipping new product, making those improvements in ad infrastructure. And look, we're talking about how user growth and engagement was decelerating. They are applying AI to actually accelerate user growth. The scale at which Meta is at, 4 billion users across its family of apps, the fact that they are able to accelerate user growth is telling you that, they definitely got that AI part right. And that's what's helping them with both user and engagement growth now.
Yeah, it's basically half of the globe is hooked into the Meta ecosystem in one way or another. I am wondering, Mandeep, given the fact that they own the world, seems like, in their eyeballs, how much can you really sort of doubt their ability to climb past this if they're able to do this without the staff, they're able to do this without the overhead, and they are deploying tools that you see as highly effective?
Yeah, look, I mean, 1 year back, we were talking about how this company was struggling, given the ad environment. And there is a cyclical component to it, no doubt about it. But what Meta did right was those investments they made in building their own foundational large language model. And look, this is a 50% EBITDA margin business. We know digital ads are the best businesses. The question remained about the relevance of apps and how much engagement they could sustain given the competition. But they've shown they have applied AI the right way. And you don't need, as many people. They could do it with 25% less people. And they're shipping new products and making those improvements that are needed to sustain that engagement.
Does it surprise you, Mandeep, that yes, they beat earnings, yes, they introduced a dividend, but the shares are up 17% after the gains that we saw last year? I mean, are these moves sort of shocking to you just in terms of how much has not yet been priced in versus this morning?
I mean, look, they guided for 25% growth next quarter, so there will be upward revisions for 2024 and 2025. And, from a stock perspective, you have to ask yourself, is this a recurring revenue business or is it a cyclical business? And the answer is the latter. And with ad spending, I think we are in the part where ad spending is recovering, but we also know it's tied to, recession or macro, and it's very discretionary. I mean, one metric I would say is they say Chinese advertisers are 10% of revenue, and they contributed to 5% of growth. Now, we know if something happens or were to go wrong with that China aspect and, Shine and Temu, they were to pull back from the U.S. market, that would make a big dent on Meta's growth. So clearly there are those factors if something were to happen on the regulatory side. I mean, if they're restricted, which they are in the EU, but it doesn't show up yet in their numbers, that's a big risk factor. So the risk factors are there, but they clearly are executing very well.
Mandeep, I want to ask about that. We're seeing such high spending by China-backed advertisers. So for Meta, China was good, but for Apple, China was terrible.
Yeah, I mean, look, in the case of any e-commerce company that wants to develop a business in the U.S., there is no better customer acquisition channel than Meta's family of apps. Yes, you could go to, the smaller players like Snap and Pinterest, but Meta is the platform where you acquire new customers as an e-commerce platform. And they called that out yesterday. E-commerce advertisers across the board ramped up their spending on Meta. In the case of Apple, I would say, we knew the units would be down and they're probably losing some share to Huawei. But I wouldn't be surprised if, the refresh does come back, albeit at a slower pace, because they haven't launched a new phone with large language models. At least they mentioned it on their earnings call yesterday. So that's coming.
Mandeep, we've heard a lot now from big tech. In fact, they've all delivered. So let's talk about it. Who's doing best when it comes to AI integration? Who's executing well from your standpoint?
I mean, Microsoft is definitely out of the league when it comes to integrating AI on their cloud and applying it to all their software and its recurring revenue. I think that's the key, that they will be able to sustain that growth, and there is high visibility. I would give credit to Meta in terms of applying AI. They have their own foundational model. They have open sourced it, and actually it's helping them develop an ecosystem. So clearly, Meta has got that AI part right, and Alphabet is somewhere in the middle. I think they need to ship more products. They need to improve the cadence, which is what Meta has shown. But Meta would be the Alphabet would be the third one in my book in terms of the ranking.
How do you think Alphabet just changes the perception of things right now? It just feels like to me that for a lot of investors, they're looking at a company playing defense. They're not on the offense when it comes to AI. There's just big worries about the cloud business, or rather the search business, being decimated by something coming from another company. How do they change that?
Well, so clearly there is a risk because 90% share for search belongs to Alphabet. And they are pitching responsible AI because they don't want to be in a situation where, you know, something goes wrong with the large language model deployments, and then they have to, you know, pivot back completely to what they have. So they are taking a safe approach where they want to apply large language models to queries where it's applicable, but not to everything they do, because it will be disruptive to their, search margins. And I think that's where it is the right thing to do, given their incumbent position. But I don't think they are behind. They seem to have caught up in terms of the large language model technology. It's just a question of how they deploy it.
Not to put you on the spot, Mandeep, but some people are talking about how it's not really the Magnificent Seven anymore. It's the Magnificent Four, the Magnificent One, the Magnificent Six. If you had to go out there and sort of bucket these, which are going to be the growers and which are going to be the laggards in the next year?
I mean, the sustainable ones seem to be Microsoft, Amazon, Alphabet. I would put Tesla and Meta as the ones that are vulnerable, which don't have that recurring revenue stream. To me, that's very important. That's why you see, the gyrations in market cap, as we have seen with these companies. It's hard to imagine how mega cap names can move like this, as was the case with Meta. But the reason is a lack of recurring revenue. And I think with AI, that doesn't change. And the first three are diversified businesses. Look, diversification helps when you get into a period of slow economic growth. So I do think Microsoft and Alphabet and Amazon clearly have that diversification aspect to it.
Hey, Mandeep, thank you. It's good to hear from you, sir. Mandeep Singh there of Bloomberg Intelligence. Before we run away and jump into payrolls, let's just sit on that stock move from Meta. 16, 17%. So $1 trillion market cap yesterday at the close. So we're talking about a move of about 170 billion. OK, so go to the S&P 500, slice it up on the Bloomberg, and go to companies valued between 170 and 180 billion US. IBM, Wells Fargo, Walt Disney, Verizon.
They're adding a Verizon this morning.
You're adding a Verizon this morning. You can't overlook this. This is huge. It's just absolutely massive.
Which is the reason why Michael Hartnett over at Bank of America is talking about how the stock frenzy into some of these names is reminding him of the dot-com era and some of the moves that he saw then. He was talking about the bubble of 1999. And we've heard this, right, for how many months? And yet we're still seeing this.
Except it's real money.
Exactly.
It's a $50 billion buyback thrown into the mix as well.
And you actually look at the cash flow, and it's incredible. And what we just heard there from Mandeep is it's a cyclical business, and they're benefiting on the way up. And then they're building in ways to benefit on the way down.
It's pretty amazing. The doubts that were around this business at the end of 22, start of 23, we're talking about the year of efficiency. It's more than that, more than efficient, what we've seen over the last 12 months.
Just sit on this stat for a second. They have 4 billion users across their platforms. 4 billion users.
Yeah.
What percentage of Earth is that? I mean, really, if you think about that.
Daily watch time across apps increased 25% from a year earlier. People are just scrolling more.
Just incredible execution. Absolutely incredible. Coming up on the program, Nadia Lovell, UBS, former Fed Governor Randy Krosner, Mohammed Al-Erin of Queen's College, Cambridge, Jeff Rosenberg of BlackRock. It is Payrolls Friday. The Payrolls Report, next hour.
we're looking for a strong payroll report.
I think the labor market is basically chugging along. It's tight. We're not adding a lot of new jobs.
The labor market, our view is it's slowing, it's weakening. If the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed.
If we just see similar softening in the labour market over the next couple of months, then I think the Fed will be ready to cut come May.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Payrolls Friday. That payrolls report is 30 minutes away. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market is positive. Your number this morning, 185. The median estimate in our survey. Lisa, gun into payrolls.
And this is the interesting thing, is that you've got people with above that in terms of expectations who are more pessimistic and people who are below that who are more optimistic. I'm looking at Andrew Hollenhorst of Citigroup just publishing, saying that they have 240,000 penciled in, but that's the last one and it's all going to go south from here. So, really it's going to be under the hood and about sort of interpretive commentary afterwards.
We heard so much of that last year, didn't we? How this was all going to decelerate and then the numbers just kept on coming. This is not where we thought we'd be. A year ago, looking out 12 months, 185, a median estimate. Annmarie, unemployment, 3.8%. Again, looking for unemployment to stay below 4%.
If it stays below 4% in this report, then that would be 2 months exactly of unemployment under 4%. You heard what Jay Powell had to say this week. He said it's the best employment market we've had in terms of this unemployment rate in 50 years. This is why in the last payrolls report, Janet Yellen, the Treasury Secretary, went on CNN and basically declared, look, we landed. It's a soft landing.
I heard what Chairman Powell said in August 2022. He talked about pain. We all agreed with him. We thought we'd have to see some pain to get inflation back down. Can't see that pain in these estimates right now this morning.
The pain maybe happened in very small places, and then it quickly was erased, and maybe those are the places that are rebounding. And this is the shift, and you've pointed this out really well, John, that basically we heard Chair Powell saying that we do not need to see weakness in order for them to cut rates, that this economy can see the disinflation while also seeing some sort of ongoing strength. And that's the shift. So even if we get a good report, it doesn't mean that they're not going to ease policy.
They don't have to push against it anymore. It's a much more market-friendly Federal Reserve, and I think the market picked up on that in the last few months. Speaking of pain, do you remember the cage match between Mark Zuckerberg and Elon Musk?
It didn't happen.
Didn't happen, right? Thomas Thornton just wrote in on the Bloomberg terminal from hedge fund telemetry, and he said this: the Meta gain is nearly 4 times the full price Elon paid for Twitter. Let that sink in. I'd say the cage match was won by Mark.
Oof, especially
that's going to sting.
That's got to sting, especially because Threads actually came in with a little bit better in terms of who they're adding on. That was well done.
That was nice, wasn't it?
Good
Just
job.
wanted to share that. Meta up by 17% in the pre-market. Coming up this hour, Nadia Lovell of UBS on the market's tech earnings lift, former Fed Governor Randy Kroszner on what the January payrolls report means for the Fed, and reaction to jobs data with Mohammed Al-Erin of Queen's College, Cambridge. All of that and more over the next 60 minutes or so. We begin with our top story. Stocks rising on big tech's earnings lift. UBS Global Wealth Management CIO Mark Hafley writing this: we believe the investment case on tech, including AI, remains intact, and recommending investors use undue correction in quality AI leaders as a buying opportunity. Nadia Lovell joins us now for more. Senior US equity strategist at UBS Global Wealth. Nadia, great to catch up with you. Let's start with this one on tech. What isn't there to like about this sector right now?
Exactly. I mean, we can't agree with that point more. There isn't much that you can pick at. I mean, the Mag 6 or Mag 5 or whatever you want to call them now, bars were high and they meet and exceeded those expectations. I mean, when you look at the AI monetization that's happening already at a faster pace, that's quite encouraging. So we see that those that have exposure to AI are faring better. But it's not just about AI. You're looking at the cloud infrastructure spending as well. I mean, you're seeing that optimization is now behind us. I mean, companies are seeing margin expansion despite the fact that you're seeing AI investment. And what that's telling us is that some of the cost initiatives and the cost control still remains tight, particularly around headcount rationalization. So some of those efficiency things that went into place are starting to bear fruit. And when we look across in terms of the CapEx outlook that we've gotten from some of the hyper hyperscalers, John, wow, I mean, that is going to be a positive for some of those AI semi companies as well as hardware companies. So we still feel good about tech. We think that this is a sector that's going to deliver very strong earnings growth this year. Some of the best in the S&P. We know that the Mag 7 has been the one driving S&P earnings, and they're going to continue to do that this year. So we're definitely in the camp of taking advantage of any sort of pullback with a focus on those names that are more enterprise facing and have AI exposure.
Nadia, these aren't large caps, they're mega caps. That's what we call them now. You also like small caps too. Can you just go through why, when you've got all this growth taking place in the mega caps right now, earnings growth, revenue growth, the stock price performance, I'm going to ask the question a different way. What is there to like about small caps right now?
Well, when you look at small cap, I mean, we saw a decent rally into year end, and some of that has faded at the start of the year. But we do think that there's an opportunity here for small cap to catch up. As you guys have been talking about for weeks now, the strength in the economy that's happening. We also know that there's a Fed that's in the position to cut this year, and that should be beneficial to small cap. And you're seeing a recovery in the manufacturing areas of the economy. You look at the ISM numbers yesterday, and also you're seeing a pickup in new orders. So when we think about a broadening out of the performance, I mean, small cap is sort of has been left behind. It's still about 20% below its all-time high that was set a couple of years ago. We think that there's an opportunity here for small cap to catch up. And so that's where we're taking our cyclical exposure. If the economy continues to surprise to the upside and the consumer holds in there and the Fed cuts later this year, this should be beneficial for those smaller companies.
All right, bear with me while I try to make this connection. But we were talking to Greg Battle earlier, and he was saying that he's concerned about Apple's China exposure. And he was looking for less China-exposed companies. How much are you seeing small caps as the way to do that? Leverage to the U.S. economy, not levered to some of the weaker spots like China?
Absolutely, Lisa, for that point. I mean, the strength in the global economy is coming from the U.S. and the U.S. consumer. So we think that that is a way to play that continued strength. I mean, and sort of buck the trends that you're seeing overseas, where there's weaker growth, whether it be in China or even in Europe. Let's just be honest about this. It's the U.S. that's carrying the global economy right now, and we think that that's going to continue to be the case, and small caps should be able to benefit from that.
If you extrapolate that out, how much are you actually checking some of the large cap and mega cap companies for that exposure and avoiding some of those? You're talking about maybe it's not the Magnificent Seven anymore. Is that something that you're kind of playing with or right now to kind of move away from those companies and shift more to those that are more isolated to the domestic economy?
Well, we're quite selective in large cap companies. I mean, even among the Magnificent Seven, we're quite selective about around that. I mean, what we're looking for is companies that also have good self-help story. I mean, when I talk about self-help, I'm talking about, companies that have restructuring opportunities, product and portfolio optimization, and cash use optimization, whether that be a return of cash to shareholders or through M&A. I mean, you saw some of this among the tech companies, and a lot of them has been benefiting from those, efficiency gains over the last year. It's not just about AI, but we think that this, you can see those opportunities in other areas of the market. When you look at even some of the banks that are looking to streamline their business and headcount rationalization, you're also seeing this play out even among some of the industrials and material names that are also launching new products and really having caution initiatives. And remember, some of these industrial and material names also have the benefit of the potential tailwind if this economy continues to, grind ahead, and you're seeing that recovery in manufacturing. And you're seeing quite a bit of an investment on onshoring as well, and infrastructure investment that should be able to benefit those companies. So I don't think it's just about tech, even though we think tech will continue to perform. We think that there are opportunities in some other areas of the market and some sectors, but you have to sort of be, single stock minded and very selective.
Nadia, let's get to the banks. 2 days, regional banks down by almost 9%. Can we talk about the monster under the bed called commercial real estate? Have we dealt with that issue now?
I mean, yes, I don't think we've completely dealt with the issue, but of course, we do believe what's been happening this past week in terms of New York Community Bank seems to be idiosyncratic, but it is something that's worth watching because we do think that, there could be some potential issues in the commercial real estate market as that wall of maturity comes over the next couple of years. But we think what's different versus what you saw last year in the regional banking crisis is that everyone is talking about it. And so that helps the market prepares better for any sort of potential risk versus last year. I don't think very few people saw coming the impact of the potential for deposit flights out of the regional bank and the asset and liability mismatch in a higher interest rate environment. We've been talking about commercial real estate and potential issues in that space for the last 2 years. So I think that better prepares the market. And the large cap banks have, been building reserve for the last couple of years around this. So they're better able to absorb, but we have to continue to monitor any potential issues within the smaller banks.
The focus is on the smaller banks, that's for sure, and not on the larger ones. Nadia, it wouldn't be an interview with you and I without talking about what's happening with energy. You knew where I was going. You became a little less constructive on crude. I remember you changed your target last time we talked about it. What was it that changed your mind? What is stopping crude from rallying?
It's the U.S., in terms of the amount of supply that the U.S. continues to produce. The concerns around the potential for oversupply in the market, aren't. We think that there is over concern, but some of it is somewhat valid. But when we do look at, sort of the inventory data, we're seeing crude oil inventory come down in January, weather disruption, as well as the OPEC plus cuts. And even yesterday, we heard from the JMC, high compliance from the OPEC cuts. So we do think that cuts will be extended in the second quarter. We're looking for modest upside at this point from oil. We do think that the oil market will remain slightly under supply in the first half of the year, and that should help support prices. But reality is things are going to remain volatile because the market needs a little bit more convincing, and we understand why. So that's why we lowered our targets, because the supply has surprised to the upside.
Got it. Nadia, thank you. As always, good to catch up on Payrolls Friday. Nadia Lovell there of UBS Global Wealth Management. On this Payrolls Friday, 185,000 is the estimate in our survey. Let's get you an update on stories elsewhere this morning. We can do that. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. NVIDIA CEO Jensen Huang says countries around the world aiming to build and run their own artificial intelligence infrastructure will only drive up demand for his company's products. Wang told Bloomberg TV nations are talking about the importance of investing in sovereign AI capabilities.
It is become abundantly clear to each one of the countries that their natural resource, which is the data of their country, should be refined and produce intelligence of their country for their country.
Tesla is recalling nearly every vehicle sold in the U.S. because some warning lights on the instrument panel are too small. Regulators say they may be hard to read, increasing the risk of a crash. The move applies to nearly 2.2 million vehicles. Tesla says it will be fixed with an over-the-air software update. The EV maker also seeing a slump in deliveries in China, down 24% from December, according to China's Passenger Car Association. And Harvard University is bracing for two bills in Massachusetts that could reshape its robust endowment and its legacy admissions policies. The first bill would hit Harvard and other colleges with over $1 billion in assets, with an annual 2.5% tax to fund state universities. The second would impose a fee on colleges that give legacy students an advantage when applying. Harvard didn't respond to a question asking for comments about the bills. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, all eyes on the labour market.
I think the Fed's threshold for pain is higher than people are wanting it to be. I think that they do expect more cooling in the labor market, and they're okay with it. In fact, maybe even welcome it.
That's coming up next. Counting it down to the jobs report. It is about 16 minutes away. Live from New York City, this is Bloomberg. Equities on the S&P 500 doing okay. Here's the why. Let's talk about the why. It's this one right here. It's Meta, up by 17% in the pre-market. Hardly talked about Amazon. That's doing okay as well, by the way. It's up by 7%. It's just two very different stories. You compare the success of Meta yesterday afternoon to the disappointment from Apple, just around what's happening with the iPhone on the mainland in China. What's happening with the overall business, Lisa? Down 13% over in China. The stock is down by close to 3%.
Even though it did beat on just in general top line earnings, I just want to point out we're not talking about Amazon at all. It's up 7%. Their market cap is $1.7 trillion. So we're talking about how, Meta's trading like a penny stock. It's up 17%. And this one, it's a, $1.6 trillion, $1.7 trillion market cap, up just a mere 7%.
What's her name? Tina. There is no alternative. US Tech, some of these names, it's pretty incredible.
Especially given the fact that they did cut staff. And I think it's important on Jobs Day, on Jobs Friday, Payrolls Friday, that we're talking about tech companies that have been able to cut staff and expand their revenues dramatically. Is this sort of a tea leaf of what's to come? Is this specific to these businesses? How much does this point to the churn that makes the labor market that much more difficult?
It's what Mike Wilson talked about at Morgan Stanley. We spent the last year thinking about AI and AI enablers, NVIDIA, and not AI adopters. And that's when the job losses start to come to the table.
And potentially for investors, that's a positive thing because that means that they have more efficiency and they can actually invest in those companies. From an economy's point of view, there's going to be some turbulent times. How do you look through this kind of volatility in the data during a sea change technologically?
True. It is Jobs Friday, under surveillance this morning, all eyes on the labour market.
I think the Fed's threshold for pain is higher than people are wanting it to be. I think that they do expect more cooling in the labor market, and they're okay with it. In fact, maybe even welcome it to try to assuage the fears of a wage price spiral and all the other things that we worried about when the labor market was so tight.
Here's the latest this morning. The January payroll report due out in a few minutes' time attests to the Fed's wait-and-see approach. The median estimate in Bloomberg's survey calling for an increase of 185,000 jobs. Former Fed Governor Randy Kroszner joins us now for more. Governor Kroszner, great to catch up, sir. Let's get straight to it. How well is this labour market holding up in the face of 5.5% interest rates at the Federal Reserve?
It's been awfully resilient, much more resilient than I think the Fed or pretty much anyone had expected. Dramatic, rapid rise of interest rates. But one of the things that I think has helped to keep the labor market strong and the economy is strong is it's really only in the last 6 months or so that real interest rates, that is the inflation-adjusted interest rate, has become positive. So even though interest rates, nominal interest rates went up very rapidly, inflation rate was dramatically above that. Inflation rate has now come down quite a bit, but the interest rate is staying at around 5%.
Randy, can you tell me why you think that wage growth isn't running away, given how robust some of this jobs growth has been over the last 12 months?
Well, we certainly have seen much faster nominal wage growth, and that has persisted even as inflation has come down. So we're starting to see real wage growth, which is great for households, but probably means it's going to be less attractive for firms to be hiring workers. It was great when they could hire workers, increase with wages going up at 4%, but they were selling things at 8% more. Now they're having to pay 4% more for workers, but they're only getting 2 or 3% more for what they're selling.
How do you sort of put into perspective, given the fact that people are more expensive for a lot of these companies, the fact that we have heard all of these layoffs announced by a slew of companies, and not just big tech, across the board? We keep hearing about that. A lot of people are saying it's just churn, it's normal, it's layoffs that were put off during the pandemic. Do you see it as anything other than that?
Well, I think the labor market is softening a bit. The number of job openings have come down quite significantly. They're still pretty good. It's still a very strong labor market, under 4% unemployment rate. Although we'll see, maybe that'll switch today. I don't think so, but we'll see. And so I think there are some signs of softening, but so far very gradual signs of softening.
What would the threshold be for you? And we keep asking everybody this question, but what's the threshold that puts March back on the table for the Fed?
I think it'd have to be pretty devastating. The Fed has made it clear from their statement that they want to be confident that inflation is coming down to their target. I thought it was a very artful move that they took out the tightening bias, but didn't suddenly have the expectations be, oh, they're going to move next time. They said they took out the tightening bias, but said, we're not ready to move until we're confident. So I think they're going to wait to see have a fair amount of data. We've got this labor market report, the next labor market report. So I don't think this one will be dispositive.
Ellen Zentner, Morgan Stanley, on a little bit earlier this morning, Lisa. She was pretty direct. You averaged 50K, which is very low. You averaged 50K across the next two reports. Inflation continues to soften. They might be there.
And people are trying to game that out, but otherwise, I mean, people are taking Powell kind of at his word in the sense that they're pricing out a March rate cut. So I guess people aren't really expecting that. But still, it would be a pretty high bar to cut in March.
Randy, I'm sure you watched that news conference. How did you react when he poured cold water all over the March meeting? What did you make of that?
Well, he's been trying to do that, and I think his colleagues have been trying to do that for a while. As I think we spoke about last month, I think he got a little bit over his skis in the previous press conference in getting people excited about a potential March move. And then he and his colleagues have spent the last 6 weeks trying to pull back from that. And I think it was quite clear that said that they've taken out the tightening bias, so the next move is going to be lower, but it's not going to be imminent. I think this is very much like what happened when the Fed pivoted back at the end of 21, beginning of 22. It took them 3 meetings. In December of 21, they got rid of the transitory language. In January of 22, they said the move will come soon, and then they moved in 23. Here, they've just gotten rid of the tightening bias. I think what they will do is at some point, either in March or May, say that they have enough confidence to move soon.
Just real quick, Randy, it sounds like you don't think it was a mistake. We heard so many people come on the show and said, say, hug the statement. Jay Powell, just hug the statement. We heard that from Bill Dudley. And then all you have to do is just stick to what the committee said. And it seemed like he was doing that. And then he was like, March's not on the table, really. We're not sure. I mean, you don't think it was an accident. You think he was actually reflecting what the committee was talking about and was deliberately trying to take that off the table.
Yeah, I think he and the committee members have been pretty clear in trying to take that off the table for the last, as I said, for the last 6 weeks, because I think there was a little bit of a mess up of communications in the previous press conference. And I think, as I said, unless there's something really pretty disastrous now, next meeting and inflation really comes down, I don't think March is on the table. But I do think it's possible for May and certainly for June.
Randy, you do think that was a bit of a mess up then, a screw up at the December meeting?
In December, I think he got a little bit over his out a little over his skis, but I think they tried to pull it back, and I think yesterday was pretty clear that it's going to take an awful lot for them to move in March, and the probability of that is extremely low.
Message received. Great to catch up, Randy. Thank you, sir. Randy Crosden there, the former Fed governor. With us around the table, Mike McKee, going into payrolls. 6 minutes away, Mike. What are you looking for?
I think one thing that is not completely appreciated on Wall Street, although some people have picked up on it, is that we're going to get revisions here. We've already gotten revisions to the unemployment rate. Didn't make much of a difference, but we're going to get some revisions to prior numbers for payrolls back from 2019 to March of last year. So that could boost the level or lower the level of jobs previously. Plus, this is the time of year when we get the new population estimate, which will mean we can't really compare the household survey numbers to previous household numbers.
We were talking to Ellen Zentner, and she was noting how CPI was revised so dramatically last year. And we've seen these dramatic revisions to jobs numbers as well. People are now focusing more on this. Why are they so messy? Why are they getting it so much wronger, less correct than they have in the past?
Well, a couple of reasons. One is that, the payroll reports are always revised because they don't get all of the responses that they send out surveys, and then they can update it when they get new information. And the trend can tell you something. If they're all negative, things are slowing down. The other is that the pandemic really messed things up in terms of the seasonal adjustment factors. And that's one of the things that went into the CPI revisions and may affect the payrolls revisions as well. Diane Swank at KPMG thinks that the seasonal revisions to December and January are going to give us a much bigger number than we otherwise would, because they've changed those, and the BLS has struggled with trying to come up with the right way to adjust these things.
Mike McKee, stay close. Did TK spike the drink this morning? Is that what happened?
It's Friday, so this is what happens when I can't work
Drop
from
by
home.
the studio.
This is what, maybe you should send me home.
Sure. Payrolls report is coming up next. Equity futures positive by about 0.6%. From New York City, this is Bloomberg. Here we go. 25 seconds away from the jobs report. The stage set like this on the S&P 500. Equity futures near session highs up by 0.6%. On the Nasdaq 100, positive by about 1 full percentage point. Going into the jobs number, we look like this in a bond market. 2-year, 10-year, 30-year. Your 2-year yield is higher by 3 basis points, 4.23. Your 10-year is unchanged at 3.8873. With a jobs report, here's Mike McKee.
Well, the January pattern continues. Big gain in jobs, 353,000. This has happened the last 4 Januaries, except for 2020. 353,000 and 216,000 was the prior month's number. Let me see what we are revised from at this point. Well, I'll get that in just a second because it's buried in the data, but it'll come up in a second. Private payrolls up 317,000. Net payroll revision plus 126,000. So first, a positive in a while. Here's the revision to payrolls last month, 333,000. So a big revision higher in December, and this may be part of the seasonal thing we were talking about. Manufacturing jobs, 23,000, only 3,000 were expected. The unemployment rate stays at 3.7%. There was a thought that it might go up to 3.8, but that is 24 months, 2 full years of unemployment below 4%. Average hourly earnings, my goodness, up 0.6 on a month-over-month basis, pushes the year-over-year number to 4.5% from 4.1%. Average weekly hours fall to 34.1 from 34.3. Labor force participation unchanged, 62.5, and the U6 rate goes up a tick to 7.2. But the headline numbers are all really good, and I'm going to have to say...
Take a guess, Mike.
Yeah. Annmarie, the White House has got to love this because they'll skip over the inflationary part.
Let's get straight to the price action, Mike McKee. Monster upside surprise on a jobs report, 353,000. The estimate 185. Equities off the high, still just about positive on the S&P by 0.25%. On the Nasdaq up by 0.6. In the bond market, we're selling off at the front end. Yields are higher by more than 12 basis points, call it 13. On a 10-year up by 7, 395. The dollar stronger, euro weaker. Breakdown on euro dollar, 108.39. We're negative there by 0.3%. Bramo, we've got to talk about 2 things. Big upside surprise, yes, on payrolls. They'll be comfortable with that at the Federal Reserve. Would they be comfortable with this? Wage growth coming in much stronger than anticipated.
Exactly where I was going to go. This is not what they want to see. This really goes against the idea that you're seeing that sort of disinflation, a gradual weakening or normalization under the hood. There is no sign of that here. The fact that you've got 4.5% year-over-year increase in average hourly hours, to me, is just a bit concerning for them, considering that doesn't get you back down to 2%.
March is looking ice cold, isn't it, after that?
Essentially, it probably is going to be off the table unless something else happens, but yet it doesn't seem to be materially factoring into people's expectations of rate cuts for the remainder of the year. That's my question. Why does this upside surprise, that is a dramatic upside surprise, not factor into the overall full-year rate cut forecast?
And Mike McKee's going to keep chewing over this jobs report. We'll come back to Mike in just a moment. We've got Mohammed Al-Arian standing by, Bloomberg opinion columnist, president of Queen's College, Cambridge. Mohammed, let's deal with the wow first. What do you make of that?
Wow. I mean, what an amazing jobs report. It just confirms that this is an exceptional labor market that's going to feed into the exceptionalism of the U.S. economy. I do think it's a bit of a headache for the Fed because of the wage growth numbers. Lots of people have been warning about wage growth, about service inflation, and that just emphasizes that warning. And then finally, for the markets, look, this means March is off the table. March should have been off the table for a while, as you and I have discussed, but this means March is off the table. It also means that you are more likely to get the 3 cuts that the Fed has signaled, 3 to 4, rather than the higher number that the markets has been romancing.
Do you think that May is potentially off the table too, Mohammed, given the fact that we're seeing wage pressures that are going in the wrong direction for the Fed?
You know, I was with you last week and I said June is what I think should happen and what I think is likely to happen. And that this report just feeds into that.
Mohammed, so what do you think it means in terms of the U.S. election? Can they cut closer to the election now, given March is off the table? What's the window they actually have?
So, Annmarie, I'm going to ask you whether you think the Fed is influenced by politics. I tend to believe the view that the Fed is apolitical and that they will do what they think is right. For the administration, this is a two-sided sword, because on the one hand, it is good for them that the economy is doing so well. On the other hand, there is concern that as you get closer to the election, you're going to start getting the weakening that results from buffers, balance sheets having been used to power this economy. So, it's good news for them right now, but I think that they have to keep an eye to what's going to happen closer to November.
I'm looking through these numbers, and the revisions are just sort of stunning as well. I mean, everything is just being revised up to the upside, also just coming in hotter than expected. Mohammed, what do you make of that? The fact that people are getting it wrong, and they're not getting it wrong for the weakness. They're getting it wrong for the incredible strength under the hood that's behind some of the strength that we've seen so far.
And that has been the consistent story, Lisa, for the last 18 months. I keep on reminding people that going into 2023, the consensus was recession. We ended up with a nearly 5% growth rate in the third quarter, 3.3% in the fourth quarter. Estimates suggest that strength remains. And pending corrections from Mike McKee, who's looking at the details, this at first sight, and I just had a very quick glance, looks like a very broad-based strength. So this is not something that you can easily assume away. This is something that you have to take seriously. This economy is still strong in a broad base.
Mohammed, stay close. If you are just joining us, blowout jobs report. Number looks like this, 353. The estimate, 185. We were looking for unemployment to climb just a little bit from 3.7 to 3.8%. It stays at 3.7%. The big surprise, and I think maybe the unsettling data point for the Federal Reserve, is wage growth coming in at 0.6% month on month. The estimate 0.3. That takes us year over year to 4.5. The estimate and previous number 4.1. Let's work through the price action, starting with equities. On the S&P 500, positive by 0.1%. On the Nasdaq, still up by 0.4. We were up 1 full percentage point. Bear in mind, there's some big moves in the pre-market by some mega tech players off the back of some stellar earnings. The Russell, perhaps the read on what's happening here, the Russell is negative by 1%. In the bond market, switch up the board and check out the 2-year, up by more than 16 basis points on a 2-year yield. 436.79, up 9 on a 10-year, 397.24. In foreign exchange, the dollar a whole lot stronger. The euro just about holding on to 108, 108.13 on euro dollar. Mike McKee, you've had some extra time to go over this one. What stands out?
Well, on the revisions front, big revisions in terms of jobs, the non-farm payrolls part. Most of the last year revised down significantly, but the last couple of months of the year revised up by an average 27,000 a month. So the economy was adding jobs at a faster pace during the latter half of 2023, which just goes to show that we have not slowed down here and the recession call is not working. Interestingly, looking at the jobs breakdown in terms of where jobs were. I mentioned manufacturing 23, construction 11,000. Service providing jobs was where the action was, 289,000 service providing jobs. And of those, professional and business services went up 74,000. That was a category people were worried about because it went down some in the prior month. And that's usually a harbinger of what's going to be happening in the economy. And here's something I haven't been able to say for quite some time.
Say it, Mike.
Eating and drinking places lost jobs during the month of December.
Interesting.
Very hard to figure out why, but the food and drinking places lost 2,400 jobs. Overall, leisure and hospitality was up, but that was mostly an entertainment stuff.
You know what the former president would do with a jobs report like this, Donald Trump? Rose Garden address. He'd get everyone out there. You'd have balloons. He'd talk about how strong this jobs market would be. What would they do?
Hats. There'd be hats.
Hats?
Yeah.
Right, with the number on top.
100%.
Printed off. Totally.
It is unfortunately a bad day for Joe Biden to do that, given what his other commitments are today. He's going to Dover, I guess, to welcome back the bodies of the servicemen killed. So it's kind of hard for him to take a victory lap. But I would imagine that they are very happy at the White House.
Mohammed, let's turn to you, sir, and get your thoughts on the Federal Reserve. You mentioned, Mohammed, that maybe June was going to be the date for you and March was too soon. Mohammed, what guided that thought to begin with, and obviously this data backs that up?
I think three things, John. One was the data, that the economy wasn't going to weaken as fast as people who opted for March thought. Two was just pure risk management. It was really important to realize that this is a Fed that does not want to make another mistake. You know, the list of mistakes is already long, as is the list of communication mishaps. And this is a Fed that recognizes that it's getting back on side and would not mess that up. And then the third issue is the dynamic of the inflation itself. This has not been a broad-based disinflation. This has been a disinflation led by the goods sector, and there's a limit to how much the massive disinflation of the goods sector, in fact, deflation in some cases, can keep you going. You got to see services disinflation accelerate, and we simply have not seen enough.
We also are starting to see a reacceleration in the manufacturing space. I'm thinking about yesterday's ISM manufacturing data showing prices paid accelerating at the fastest clip since December 2020. And then I'm looking at this, manufacturing jobs. There were 23,000 that were added in this latest payrolls report versus the 3,000 expected. Do you see signs that what you see is the manufacturing sector catching up to services, not the services going down to manufacturing?
So that's the worry if it happens in prices. If it happens in activity, that's a huge relief because you get this continued immaculate disinflation that we all want. We don't want to sacrifice growth too much. So if it happens in activity, that's great. If it happens in prices, that's the concern that people have. Look, I haven't even referred to exogenous issues. You know, my view is that we are now living in a global macroeconomy with insufficiently flexible supply. And we're getting evidence of that on a weekly basis. The one number that's a disappointment in this report is labor force participation. We all want higher labor force participation. We want the supply side to enable this immaculate disinflation. And unfortunately, we didn't get higher labor force participation.
Mohammed, do you think that it was a policy error for the Federal Reserve to remove the idea of a rate hike from the table?
Interesting one, Lisa. No, I don't. I think the mistake, honestly, is in how they communicate. You and Randy Krasner were talking about the communication mishap in December. I view what happened on Wednesday a communication mishap. The statement that came out of the FOMC was very well drafted, was finely crafted, and gave them what they want, which is the optionality. The sudden pivot in the press conference to March is off the table was unnecessary and unhelpful, to tell you the truth. Look, I agree March is off the table, but if you have a statement that gives you optionality, you stick to that statement. And I agreed with the speakers you had on Wednesday that he should have hugged that statement. It raises all sorts of questions in terms of volatility during these press conferences, in terms of who do you believe, who is the chair speaking on behalf of? Is he speaking on behalf of something that happened in the committee that we weren't told in the statement? Or is he speaking on his behalf? You don't need all this noise when the Fed should be signaling, because ultimately it will weaken the Fed's signals, and that would be detrimental to good policymaking.
Let's build on this and bring in Jeff Rosenberg, portfolio manager of the BlackRock Systematic Multi-Strategy Fund. Jeff, great to catch up with you, sir, following the Fed decision on Wednesday. Let's do it again this morning following the data this Friday morning. Your response to this one, Jeff, just a blowout jobs report.
It is at first blush, Jonathan. You often say the first reaction is not the last reaction. So just a couple of things to consider here in terms of this first reaction. You know, number one, and I think it's been mentioned already, in terms of headline payrolls, there's a lot of seasonality in this number. If you look at the spread of expectations, it's one of the widest expectations spread of any month. This is, I think it was mentioned before, you know, consecutive January upside surprises. You have a lot of seasonality effects that may be overstating the strength in that payroll number. Number two, in terms of AHG, I think you have to be a little bit careful about reading too much into the big upside surprise on AHG. A couple things going on there. Number one, you always have a mix shift Mike McKee went through the mixture of the jobs. A lot of that, what you saw there was that the lower end paying jobs were actually not as large of a contributor as the higher end. And additionally, the reduction in the work week also flatters the AHE number. Much more important is what we got earlier this week in terms of ECI, kind of validating the disinflation in terms of wages. So not to take anything away from the initial reaction of this is a very strong report and a strong labor market. And what that does is it's less about kind of, Lisa, interesting question. Agree. Is should they be tightening? No, there is a pace here for normalization. It's just not as quick as what the bond market was expecting, and it's not as soon.
Jeff, the takeaway from Wednesday's news conference for many was this Fed would embrace stronger data, and if we weaken, they'd be able to step in and reduce interest rates perhaps sooner. That reaction functioned far more market friendly. Is there anything about this story that changes that in any way, shape or form?
I think it reinforces it, in kind of thinking about what the market reaction would have been, upside miss, downside miss. I think we're right along those expectations. Stronger than economic data, that's good news. This economy is strong. But I think what it pivots is that the Fed doesn't have to normalize policy as quick. You asked me a couple of meetings ago, my answer was June. What's the rush? Similar to what Mohammed just said, there's not a rush if there's not an economic slowing. And I think as you see the strength in the economy, the pivot in the focus of the market and the conversation is going to move away from inflation. We've kind of won the battle on inflation. Still a debate as to where that settles in, but much more about how strong is this economy and what that tells us about what the Fed continues to believe and say. They think they're restrictive. But if the economy stays well above potential is what we've been at, then you got to question where that restrictiveness really is. And that really calls into question the longer term path of expectations of Fed cuts this year.
Which is exactly why I'm wondering, and I'm interested in the sell-off in the 10-year yield up almost 10 basis points. Does this make you, Jeff, not like longer term bonds nearly as much?
Well, we've always had, not always, but in this cycle, a more of a preference for the front end of the curve. A number of reasons for that. But to answer your question, yes, it just reinforces the skepticism we have in terms of long end duration in portfolios playing the role that it used to. Flight to quality used to mean you buy the front end. And now I think that's what it means again. So for investors looking for that ballast in their portfolios, it used to be you wanted to own the back end. Now you want to own the front end because that's where most of the interest rate declines are going to occur. And that back end is vulnerable to an increase in term premium, inflation premium. And I think that's what you're seeing here today as well.
Mohammed, will you agree? Because I know that you do think that structurally we're headed toward higher inflation. Do you think that almost the Fed is embracing that in sort of this sort of subtle way, and you're going to see that increasingly priced in?
Embraced it yet. I hope at some point it will understand it. What Jeff just said is really consequential because it means that our traditional reliance on longer duration bonds as risk mitigator is less effective. That is a really consequential statement because it raises the question of what else can play that role. You can't get as much risk mitigation from the front end. So this is just, it tells you how complex portfolio management has become as we normalize in a world that has issues on the supply side.
Going forward, I'm wondering, Jeff, what you're looking for to understand and whether it's relevant to you, whether the Fed's going to cut rates in May or June. How far ahead of an election cycle, how far ahead of economic data actually turning do you think they need to really get?
Well, they want to get out in front of inflation. Powell said very clearly, we don't want to wait till we're already at 2%. On a 6-month annualized basis, they're at 2%. They want to see that in the next, so many months. That's what we talked about on Wednesday. They want to be validated in terms of not making a mistake on inflation. And those are the maintenance cuts. And the maintenance cuts are inflation has come down. You don't want real interest rates to go up, so you maintain the real policy rate by cutting rates. I think that's most of what the Fed is signaling. The bond market has gotten ahead of itself in expecting calibration cuts, meaning they think policy is too tight, the economy is going to slow, and therefore the Fed's got to start to cut. Nowhere do you see that in any of the data, especially in today, again, reinforcing the notion that policy may not be restrictive. And so you don't need the 5 to 6 cuts that the bond market is pricing in. And so bonds got to take that out. And, that's problematic for the valuation side of financial markets because they like lower interest rates, not higher interest rates. So we're going to have to calibrate that and work through that.
Well, let's get into that. Let's talk about what's happening with markets right now. Let's park payrolls, stellar jobs report. Let's look at one single name, Meta, in the pre-market up by something like 17%. Jeff, what is going on with the valuations of some of these markets? The fact that we've got rates up to 5.5%, that credit spreads are still pretty tight, that equity markets are at all-time highs. What is going on with financial conditions?
So broadly, financial conditions are easing. I think we got to be really careful about looking at the stock market, looking at Meta, looking at the Magnificent Seven. They're in a different stratosphere. They're operating more off of the numerator than they are on the denominator, meaning earnings and earnings growth are so powerful for those stocks. They're perceived as secular growers. They're almost treated as defensive and flight to quality insurance in the equity world because of that persistence of growth. And I think that's the Meta story here again this morning. I think you got to look away from those stocks to see underneath the surface what's going on. I think you mentioned earlier Russell 2000. That's a much better economic barometer of growth and inflation and interest rate sensitivity to see what's going on there. So you separate those two things out. And for the rest of the stocks, there's a lot more denominator effect because the numerator side in a slowing nominal GDP environment isn't powering those stocks and powering those valuations through. It's much more about what's happening with the path of the underlying discount rate.
Mohammed, what's your view on the same thing? What's developing in financial markets and financial conditions?
Well, first, let me tell you, my reaction to Meta was what you said earlier, that you don't expect a 17% pop on an earnings from a company that large and that well covered. And that in itself, it tells you something about what's happening in the market place. Look, financial conditions have loosened a great deal. November, December was a wonderful gift to financial conditions, a wonderful gift to investors. And I think that we're going to take some of this back in the next few weeks.
Mohammed, how much of that is tied to the idea of interest rates remaining high for longer? A lot of people now questioning whether we can just live with 5%, 5.5% benchmark rate. Do you think that that's going to be called into question as time proceeds?
The other day, I was talking about a stock versus flow issue. On a flow basis, you would be very constructive on the economy and you would be constructive on the market. But that's a stock. That's what we bring into 2024. And we bring in two things. One is the resilience of balance sheets is lower. And secondly, you have a small but consequential set of asset classes that have not yet adjusted sufficiently to the new interest rate reality. So every once in a while, we'll have a concern about banks. Every once in a while, we'll have a concern about commercial real estate. There's going to be issues about private equity valuations. And over again, the question is going to be, will you have contagion? Will you have contamination? So we have to get over this stock issue. I think we can, as long as we don't slip on the flow issue.
Jeff, what's your take on that?
I think Mohammed brings up really important points. And, you look back at the New York Community Bank issues, and it is really about this underlying commercial real estate uncertainty and the adjustment to higher interest rates. And I think he's absolutely right. I think there's a lot of resilience more broadly when you look at commercial, when you look at consumer. It was the benefit of having 1-2 years of zero interest rates and the actions that players took in that environment to secure their balance sheets, to extend debt maturities. They've mitigated a lot of the interest rate sensitivity. But as Mohammed highlights, that doesn't mean we've eliminated it. And so there is this kind of nagging notion of where is the risk out there. And when investors kind of get all in and technicals get overbought, and you have that vulnerability, and then you have a little spark, you can have some of this pullback. And I think that's what we're seeing here in financial markets.
Mohammed, just to give you the final word, is June still the day, the month for you, for the Federal Reserve to cut?
I think so, yes, John.
Mohammed, appreciate your time, sir. As always, great to catch up with Mohammed Al-Arian there of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. Let's just finish on the numbers and wrap it up. Bramo, 353 against an estimate of 185.
And not just that, but an upside revision to the previous month, really seeing an average of 27,000 new jobs additionally added in the 3-month trailing average. Average hourly earnings coming in at 0.6% rather than 0.3% for an annualized 4.5% gain in wages. This is not a picture of a weakening labor market.
It's a pretty incredible number for this White House to go around talking about AMH for the next month or so.
Absolutely. 2 straight years now of unemployment rate 4% or lower. This is something they can really win on. The issue is when you look at the polls, Americans continue to say, while they are still starting to feel a little bit better about the economy, they're worried. They still are worried about inflation and price pressures, but also they just don't trust Biden on the economy. They trust Trump more. At least our polling shows that in the 7 critical swing states.
Those polls just aren't changing. Consumer confidence starting to turn around just a touch. 353 is the number. 185 was the estimate. 3.7% on unemployment. Wage growth coming in hot at 0.6% month over month, year over year at 4.5. Coming up on Monday, we'll be talking about this jobs report with Laurie Calvasina of RBC, the OECD chief economist Claire Lombardelli, Ed Yardeni of Yardeni Research, and Subhadra Japa of SocGen. From New York City, for our audience worldwide, have a wonderful weekend. Counting you down to the opening bell with equity futures positive on the S&P 500 just by 1/10 of 1%.